This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. Reaching back into the archives today, a three-way author, Gregory Zuckerman, talking about the famed trader, Jim Simons, trader, Wes Gray, and author, Ryan Holiday, always the stoic. Three great thinkers, three great, insightful perspectives on life. What more can you ask for? Jump right in and give your mind a little of that food for thought. I hope you enjoy. And if you ever have any feedback, if you ever want to propose a guest to me, if you just want to say anything to me, if you want some extra trend following insights, I'm really easy to reach. Michael, my first name, at Covel, my last name, Covel, 1L.com. Michael at Covel.com. I want to hear from you. Tell me anything. Give me your success story with trend following. Give me your feedback on this podcast. Give me anything. If you've got a great connection who you think would be awesome here with me, I want to hear from you. Without any further delay, let's jump right into Gregory Zuckerman, Wes Gray, and Ryan Holiday. Quite lucky today to have a really interesting guest, the author of the new international bestseller, the man who solved the market, how Jim Simons launched the quant revolution. My guest today, Gregory Zuckerman, longtime Wall Street Journal reporter, decades at it, quite the investigative guy, knows how to get behind the scenes and tell a great story. So Jim Simons, I think Greg has put to bed any thought that there might be a better trader in the history of the planet than Simons. The guy just mints money at his company, Renaissance Technologies. The book is great. I highly recommend it. Today, I take Greg across Mr. Simons' world and try to get to some of those insights that we can all use, we can all learn from, perhaps. You know, this is one of the smartest guys ever. I mean, just a brilliant mathematician. I mean, that was before he even got to investing. Then he got to investing, and he's dominated like that, like none other. Without any further delay, without any further rambling from me, let's jump right into my interview with Gregory Zuckerman. Listen, back in the day, I think somewhere, and I'm not asking you to recollect, but I think we might have exchanged emails 15 years ago or something, because I think you're a guy that has been in kind of this following these outsider quant traders for a long time. And you know all the names, you know all the players.
I do. I've been following this for a long time. I'm focused very much on the buy side, be it hedge funds, once in a while, Bill Gross, and mutual funds if something interesting, or Jeff Gundlach. But yeah, I'm very buy-side oriented. When quant trading is interesting, I'll focus on that. When long short stuff is blowing up, then I'll move to that. But I'm a buy-side guy, so yeah, we could have.
Here's where I want to jump in with you, because I think, at least for me, for someone who's written quant books and looked at performance tables, I immediately, in your book, and hopefully I'll be the first person to start with this lovely topic on all the interviews that you're going to be doing. Oh, by the way, congratulations, book in the top 50 of all books for sale on Amazon at this moment. So that's pretty damn cool.
Yeah, so far the reaction's been really strong. A little bit surprising, frankly, but it's been great.
So I'm on page 331 and 332, and there's a performance table on there that I've never seen before. That might not mean anything, but I know a few people here and there, and no one's ever shared it with me. And I would love for you to tell me about that performance table. Was it just something that came along in the natural process? Had you seen it earlier? Because that's a really interesting table. Management fee, performance fee, return, before fees, size of the fund, medallion, trading profits. It's an amazing 2 pages.
Yeah, like much in the book, it looks like it came together easily and quickly, but it was a lot of late nights and frustrated days.
Who did you cajole for those 2 pages?
It was many people. It was cobbling together information, data, annual reports, early annual reports. Some of it was official stuff that they used to share with investors when they had outside investors. That was the easier, I mean, not easy, but it was easier to get that kind of information. Early on, they had some outside LPs. If you track down some of the old timers that are still around, and that was another challenge of the book, that not everyone who's in the know is really around anymore. Even during the course of my reporting, some passed away. We're talking the 70s and 80s are important periods of Jim Simon's life. The earlier periods of Medallion's history, there were some people alive who still had some annual reports. Then you have to encourage them, cajole them to share them with you. Some were more eager to share than others. The more recent stuff, I had to develop sources within the firm. That was even harder. This is the hardest project I ever did in my life, hardest piece of work I ever did in my life. I'm glad to put it all together because, like you said, I had never seen it all on one page or 2 pages, as it were. I wanted to see it myself.
Let me take you to the question that then really starts to intrigue me. In my world, looking at a lot of these, quote, trend following guys, I've always found the month by month tables fascinating. You can see so much. For example, if you look at October of 2008, you see all this trend following performance that was straight up. That's so interesting. Did you have a chance to see the month by month?
I saw some of the month by months, not enough to include in the book, not for the entirety of it. I did get people on the inside and outside who invested in Medallion who described the month by month. And like you said, when I talk to people about the performance, almost everybody focuses on the returns, 66% a year, 39% after fees. They are remarkable, but internally, and to sophisticated investors like yourself, just as impressive, or maybe even more so, is the Sharpe ratio, which they've gotten up to 7.5 at this point, and the fact that monthly returns are pretty steady, almost always. They've had a few down months, they have, but not many. And that's as impressive as the outright returns, the numbers.
Is there anything else like this? I mean, behind the scenes, is there some Jim Simons that's even more publicity shy than Jim Simons?
I don't think so. I think there are some that are even more secretive. There's a group out in Princeton that reportedly has amazing returns. I don't think they're as good as Medallion. I don't think they're as big as Medallion. Medallion at this point is $10 billion in size, and they leverage that up, obviously. It's not just the returns and not just the Sharpe ratio, but the size at this point is pretty substantial. Earlier on, they capped it at smaller numbers, 5 billion, and then even earlier periods much lower. They give back all the profits each year and they start over again with about $10 billion. There are others who've had ridiculous returns, but they're generally smaller. I haven't been able to substantiate anything like this. There could be something somewhat similar. I hear rumors about smaller groups, and yet still substantial, but not as big as Medallion.
You know what's really interesting here, too, staying on these 2 pages of performance and size of fund, is even though 10 billion is substantial, these days, when you look at groups like Bridgewater, AQR, I mean, this 10 billion looks small. So clearly, just philosophically from the top, they're running a very different shop in the sense that they obviously don't want to have 200 billion under management.
Yes, they've made a conscious decision, and I write about it in the book. It really contrasts with others, like you said, with Bridgewater, with AQR. AQR is a quant shop, and the returns been good over the years, nothing remarkable. People criticize them a lot as being a marketing shop more than a performance shop, probably a little overdone, that criticism, but they are a monster in terms of AUM. You can make it a broader statement. So I wrote an earlier book called The Greatest Trade Ever about John Paulson and those who anticipated the financial meltdown and did really well. And Paulson made $20 billion over 2 years, but then he made that same classic mistake by getting too big. His AUM, I think, got up to 30, maybe even $40 billion. And then the resulting period was really poor. He's underperformed. Jim Simons and Medallion made a decision. They'd rather have performance than AUM. They'd rather focus on the incentive fee than the management fee. They could be managing a lot more. Now they have some outside funds. So they overall do manage about $68 billion. But the key fund is the Medallion Fund, and they won't let people in, and they've actually offended early investors, even people close to Jim, friends and others who once were investors in Medallion and were pushed out. They made a conscious decision. We want performance to be strong. We don't think we can do it above a certain level. Today, it's $10 billion. We're going to kick people out, and we don't even care about the management fees.
I'm going to take you back in time in a few minutes to get at the nexus of the book, your starting point. But I want to stay here for a second because as we talk about this great performance, the obvious follow-up question that everyone wants to know, and since you are the author of this fine international bestseller right now, everyone wants to know, Greg, what does Jim do to make all this money?
Jim Simons developed a different way to invest or trade or speculate, however one puts it. There are always those who were doing technical analysis. This is a cousin of that, but it's on a much, much more sophisticated level. There were always people using traditional methods, such as the Peter Lynch approach. Know what you invest in. Your wife comes home with a nice pair of pantyhose. Hey, honey, those are new. Where did you buy them? I'm going to buy Legs, the company. And he made a lot of money. There were always those like George Soros and Stanley Druckenmiller sitting back, looking at global trends, economic outlook, estimated interest rates, et cetera, make big bets. Jim Simons was the pioneer, not the only one. He was a pioneer in a very different approach. That's using mathematics, developing predictive algorithms. This is way, way, way before Mark Zuckerberg and Silicon Valley embraced that approach, and developing an automated trading system. Early on, they couldn't put on the trades within their system, but their automated system told them what to buy and what to sell. It's all about looking for patterns and looking for short-term patterns.
What's the definition of short-term? Are we talking light speed, a day, or is it all kinds of short-term time periods?
From my reporting, I've determined that the average holding period is about 2 days. Some people confuse them with high-frequency fast traders. They're not that. They've tried that. They haven't really succeeded with that. They kind of don't think that's their niche. That's not their focus. They don't get in and get out in a millisecond ahead of you and I. They try to look for short-term patterns, be it moments to months, is the way they describe it. It could be a few days, it could be a few hours, but it's not a second or under a second. They're not about building their computers to that point. And frankly, they've got very, very powerful software and technology and computers, needless to say, hardware, but it's not as powerful as some others. And they kind of poke fun at themselves to some extent. It's short-term patterns that you and I aren't aware of, and they repeat, and their thesis is that human behavior repeats, and they take advantage of that. They do the best in periods of panic because human behavior seems to repeat itself in those periods.
They trade everything. They started with futures and went to stocks, but in terms of markets, they're going to go from stocks, bonds, commodities, you name it, metals, ags, everything under the sun is going to be in their portfolio.
That's exactly true. So until about 1994, they were only making money in commodities, in currencies, and bond futures. And they were about $800 million of size at the time. People internally said, hey, we're doing fine, Jim. Let's keep it going. No reason to try to expand into equities, which was the area that was frustrating them. They could not figure out stocks. And there were a lot of frustrations along the way in the whole Jim Simons Renaissance story, which was kind of one of the surprises that I found. Jim said, no, I want to be bigger than $800 million of assets. I want to change the world kind of thing. I want to be the one to figure it out. And there was some disagreement within the firm about that. Jim is a guy, he's a fascinating guy because he's a mathematician. He can talk about that. He's a quant. He's an academic, but he's also a guy who loves money. He's not ashamed of that, and he wanted to get really wealthy. And the only way to do that is do it in equities because it's just a deeper market. You don't run up into ceilings and limits with things like soybeans and some small currencies, and that's what they were trading at the time. They finally figured out how to make money in equities, and they were off to the races. But if they hadn't, they really would have been another nice, successful hedge fund, but a narrow one.
Before I take you back to the start here, I want to take you back to the start of Jim. I can recall probably in the mid-1990s seeing these old Financial World magazines. They weren't old then, but current then. And you could see the top 100 players on Wall Street. And he started to sneak into these lists. There wasn't any other information on him, especially when the internet started to kick in. You couldn't find anything. Roll forward about a decade, sometime around 2005. I'm in an office with a fund manager who today has a net worth exceeding $1 billion. And we were talking about these kinds of topics. And he looked at me and he said, "What about Jim Simons? What does he do?" And I'm like, how the hell do I know? You're the one that's made the bloody fortune. So it's really interesting where you're going today. I can see why, if so many preeminent competitors have been curious about him, and then that trickles down to the Twitter world. I mean, all of a sudden you've got the entire world like really curious. What's the backstory? Let's take it to the backstory, because Jim is a guy, I want you to start this. I'm going to kind of give you a lead in, but I mean, he's basically famous for math formulas that most of us mere mortals can't begin to comprehend or understand. That's before he ever got into trading.
That's exactly right. And it's my view that even if he had never started any trading, he'd still be worthy of a book. He lived a full life even before he changed Wall Street. I'll explain. He grew up in Brookline, Massachusetts, middle-class guy. Father was an executive in a shoe manufacturing factory. He always loved math. He had a passion for math. He kind of learned from his father to follow his passion because his father didn't. His father had a thriving career in the motion picture business. Family obligations arose, and he felt compelled to go work for the family business, the factory business, and he wasn't happy. And Jim Simons noted that and said, you know what, I'm going to try to follow my passions. And they were mathematics. And he did well at MIT, got a PhD at Berkeley, began teaching. He taught. He was a popular teacher at Harvard and at MIT. But he always, as I suggested earlier, also had a passion for money along with mathematics. He got involved with this business. He helps start a business in South America. He needed money. He had some debts at that point, and he needed to find a way to make some more money. So he got an offer to go work for an organization called the IDA, which helps the NSA in the United States. And basically, it's not an arm of the government, but they help the government. He was code breaking. He was fighting the Russians, the USSR, in the Cold War.
1970s, right?
Exactly. I was about to say 1970s. Yeah. He was very successful as a code breaker. He learned how to build algorithms there. He also learned that he wasn't very good as a programmer. That lasted for a while. And he doesn't consider himself a very good programmer, but he knows how to hire them. But he also learned how to interact with some of the smartest people on the planet and how to recruit them to some extent, or he watched how they were recruited. And he subsequently went to Stony Brook University in the United States, in New York. It wasn't a really good school at the time, wasn't a good math department. He took it on to build it, and he did that. And again, he also honed those skills and recruiting skills. And in some ways, my book, The Man Who Solved the Market, obviously it's an investing book, but it's also a management book, I think, because you can learn from Simons as much there. He's got a remarkable ability to find talent, to recruit talent. Got a few tricks up his sleeve, getting people to leave their careers to join him. But he also is remarkable in how he gets people to work together. We could talk about that later. But basically, here he was in 1978. He had conquered all these different worlds, mathematics. Along the way, he got impressive awards. He was really the top of the field. He's one of the most important geometers of the past century. His work has really impacted all kinds of different areas in physics, others that you wouldn't have necessarily expected. Then he was, like I said, developed this department at Stony Brook. But he also got a little frustrated with mathematics, and he likes trading. So he didn't really do much of it. He had dabbled here and there with his wedding money and other kind of money, gave up on it. But something about it really spoke to him. He likes that thrill we get when you make a good pick and it goes up. He liked that. He really enjoyed it, even though the people around him were like, why are you wasting your time trading? Or he didn't even know he was trading. These were mathematicians who really didn't trade on their own. He set out, and currencies were becoming unshackled at the time. Prices were moving in currencies. And he said, you know what? I'm going to try to figure out and trade currencies. And he started in 1978. But it took many, many years for him to figure it out. So he really kind of gave up on his early career. He was an acclaimed mathematician, and he gave up a lot to try to make it in trading. And he found himself in this little strip mall in Long Island, spotty phone service, no one willing to work with him, unable to figure it out. And it took him a while.
So he started his firm officially trading the late 70s, and his first big year was not till the late 80s or first year, 1990? Lay that scenario out.
Yeah, so 1978, he started trading. He recruited Lenny Baum Welch. He's famous for that algorithm. If any of your listeners are aware, he's a pretty well-known mathematician in his own right. And again, Simons is really great at recruiting and bringing them on board, getting people to work with him, even if people have no interest, and these people didn't have any interest in trading. Lenny Baum, like many others who Jim Simons recruited, really had no interest in investing, which is kind of ironic because they're the ones who conquered the investing world. He started in 1978. They had a lot of ups and downs, and it wasn't clear what approach they should take. For early on, they tried modeling the market. It didn't really work. He brought on another mathematician named James Axe, who's also well known in his own right. Eventually, Simons and Lenny Baum shifted to sort of traditional macro kind of investing, where they would look at the news, try to anticipate the news, hire economists. They had this guy, not a well-known economist at the time, named Alan Greenspan, who they had consulted with. And they tried to trade like most others, and there were a lot of winning days and there were a lot of losing days. They made a lot, they lost a lot. The ups and downs really just left him sick to his stomach, literally, Jim Simons. And he said, I've got to find a different way. I got to find a better way. Got to find a way where the model works on its own and the system works on its own. And he believed there's some structure beneath the market that people aren't aware of, some way to pick up these patterns that we're repeating. And he was convinced that he could be the one to do that. But again, like you said, it took years of back and forth.
That notion of structure, how close did you get as a guy who's been around interviewing, investigating, doing a lot of homework behind the scenes for a long time? How close did you get to really wrapping your arms around that structure, do you think?
I got a better sense for the fact that there's more order than we imagine in the markets. It's not as random. I became more convinced of that there are repeating patterns, and that's what these guys and some women do all day long. They find that, but there isn't any like one secret. I went into the project thinking, okay, Greg, I bet you at Wednesday at 11:48 each week, I don't know, commodity prices, these commodities always go up. It's not like that. Their system, they don't trade like most others. It's all about relationship. People, when I go on these shows and stuff, CNBC, whatever, what does he think about Google, Greg? No, they don't do that.
You knew I was not going to give that to you today, right?
Yeah,
Come on.
That I do, yeah. That I knew. But the average person is kind of, they'll still do it. They'll ask him at these events, once in a blue moon when he'll do like a scientific event and they get some average person there. Or when you see even a quant, forget about Jim Simons, when you see a quant interviewed on TV.
David Harding comes on CNBC and they ask him what's going to happen next, that kind of thing.
Yeah, you roll your eyes. I'm not saying I came into it thinking there'd be anything like that, but I thought there'd be something a little bit closer to that. And that's not how they invest. What they do is they hold about 4,000 or 5,000 stocks long, about 4,000 or 5,000 stocks short. They make their money on the relationships among different individual stocks and other investments as well, meaning a group of stocks versus an index, a group of stocks versus a factor, a group of stocks versus a different group of stocks. It's almost an engineering and a technology achievement on their part, and they put together this sophisticated system to put all these different factors and other elements together into a system. What I came away with, and you asked me what I came away with, is just the understanding that there are many more factors, to use the terminology, affecting markets than you and I are aware of. We all focus on things like, I don't know, earnings, revenue, and then you get more sophisticated from there. It's my belief that there are many more, and there's some that just work for a little bit of the time, some of the day, etc. The Simons and his group are aware of more of them, but it's also important to remember that they don't get it right. Yeah, they're the greatest investment team ever. They're up 66% a year since 1988, but they're somewhat humble. I don't want to go overboard, but they're somewhat humble because they get it right barely more than 50% of the time. The point is that they're somewhat akin to a casino where they'll trade a lot. If you trade a lot and you get it right a bit more than 50% of the time, you make a lot of money. It's not like they are superhuman and they get every trade right.
I caught a clip the other day from my buddy Barry Ritholtz talking to Eugene Fama. On top of that, you just mentioned the random walk. How does a guy like Fama You mentioned the random walk. And then on the other side of the equation, we have Jim Simons. What are us folks out in the audience supposed to take from that? Because Eugene Fama got a Nobel Prize for, I don't want to reduce his work to just saying it kind of says that a Jim Simons should not exist. But isn't that kind of what he says?
Yeah, I guess he would argue that Jim Simons is that monkey writing Shakespeare.
Hold on. Let me get to that performance chart again. How many billions did Simons make?
You put enough monkeys into a room, you will get one writing Shakespeare by definition. I agree with you. And if you talk to Simons about it.
Does he believe that too?
No, he does not. I've talked to him about it. He believes that there are inefficiencies in the market. There aren't many of them. I really don't want people to come away from the book saying, and some people have kind of suggested as much to me, well, maybe I can be like Jim Simons. I could build something like, no, do not try this at home. You could do a variation. You could try to do it on a small scale. You can be inspired by him. You can learn lots and lots of lessons, both individual investors and sophisticated ones. But to say that you could create something like this, he may be that monkey. And I don't mean it in a random way. I mean, there are
so much more brilliant, and such an interesting combination of assets and people that he's brought together with resources that the average person just is never going to have access to.
I think that's right. So people nowadays, now we're jumping around a little bit, but people on Wall Street, financial industry, they say, oh, I've got PhDs working for me. I've hired PhDs. What they do at Renaissance, they're not just PhDs. It's easy to forget or not to understand that these are the people, these are the tops of their fields. They could be at the tops of different departments, and they were at different scientific departments around the country. You take like a David Donahue from Stanford. These are just award-winning top PhDs. They're not just PhDs. They're people, again, in physics, in astronomy. They love to hire astronomers. The tops of their fields. They're not just hiring smart people. Everyone's smart out there. They're competing with smart people. These people have just done award-winning stuff, and he'll somehow get, and I can explain a little bit how, but he will recruit. These people have no interest in investing. They're award winners, and they see superstars in different fields. They'll target them. I don't think the David Hardings and the other competitors and the Cliff Asmuses are able to track this talent internally within Renaissance. They worry about talent and fighting for talent, but they worry about it versus a Google or a Facebook, not a Two Sigma.
As I look at this performance table still, and I see this consistency, you're describing to me an ongoing desire and ability to bring in top talent. But I see this consistency, 2000, 98%, 2001, 33%. That's not consistent return necessarily, but it's consistently positive. And you seem to be describing month by month that's consistently positive. My thought becomes, what are all the new people for? I mean, if Jim has discovered the structure, is it a structure that is changing in a way so much that all this brain power is required? Because I mean, this has been going on for a long time. This return stream is not new. So how much of this is core precepts that they put together with some of the original team? And is any potential new hires with the great pedigrees, is some of that to throw all of us off to think that all of that is needed?
Here's the answer. The original precepts are still very important, and I write about them in the book. There are principles that they've established. Some of it is breaking the day into bars that others kind of followed and copied afterwards or developed on their own, but still work for them. But it's a constant battle. It's hard to explain, but despite these returns, I know they look like they figured it out. They don't feel that way. The market is changing, and they're aware of that. So I've talked to them about ETFs and the shift to passive. So a lot of what they do is they take advantage of the mistakes that we all make, that the average investor makes. I've said to them, what happens when there are no more dentists out there to take advantage of? There are fewer of them. As we all know, back in, 1999, you go to a barbecue, everyone's talking about pets.com and their shares going up, et cetera. You don't get that anymore. I don't know if people are going to talk about their investments as probably Bitcoin or something like that today. If the nature of the market is changing, and I think it is, active investors are shrinking and passives are rising. The behavior of the market seems to be changing. The behavior is also changing because of the man in the White House, the Twitter-based decisions. That's a constant battle for people internally.
But Jim's making money regardless of who's in the White House.
Yes, he hires these superstars and he says, go figure out how to keep up with this market, this ever-changing market. You wouldn't think it, but there's a real sense of urgency within the firm and pressure, and it doesn't feel like a university department. The talent is like a university department, but then when they get there, there's a feeling of a Wall Street firm and the pressure, and they work hard. It's a unique blend of the two. You're right. From the outside, we look at these returns, they're like they can phone it in from an island, and that's not how they feel. They feel it's a constant battle. They have to keep bringing in new talent. Like I said, they do have these outside funds, Reef and others that are available to institutions. They don't trade exactly like Medallion, but they are important to the firm too in terms of talent and hiring. And I talk about within the book, Jim was going through a personal challenge at the time. In some ways, I think he needed a distraction. That's why he started these funds. But now that they've gone, they wanted them to be successful. It's a weird thing. Like Jim Simons, the people within the firm are well established in academics and elsewhere. They join. They don't really need the money. They're not really out to get the money. Once they're there, I really do think they're hooked. And I write about it in the book. You don't want to let your colleagues down. There's some competition involved. You want to show that you're a star. You want to keep making the money once you get hooked to the money. For all those reasons, there is an urgency within the firm. And the markets, again, are always changing. They have to keep up.
Let me keep playing devil's advocate and pushing back. You start the book off really diving into, it's quite a challenge. I can really relate to where you had to go with this, but the secrecy element. I will let you just go down the path of kind of outlining some of the secrecy that you had to deal with, because this wasn't something where initially I don't think people were really saying, Greg, come on in and we're going to do a biography. Come on in. Everyone's going to talk to you. It wasn't like that. But when you're dealing with that much secrecy, is there a side of you, even though you're a cagey guy with lots of experience, is there a side of you where did you ever feel at a certain point in time and doing all your homework that people weren't being frank, or they were leading you the wrong direction, or there was disguises being thrown your way?
Yeah, you have to worry about that. It's a good point. These guys are cagey and they're secretive and they sign 30-page non-disclosures. Here they are talking to you. Why are they, you wonder? I was wary. That's why you have to check these things with others. But I do feel that good stories in life want to come out. People want to talk. They've just gone through this experience where they've worked at, or they currently work at, the greatest investing firm mankind or modern finance has seen. Kind of part of them wants to talk about it, wants to share this experience. They're going to go to their graves without sharing some of the insights or experiences and stories and drama within the firm. And part of it also is, and now we kind of get into sort of the strategy as a writer, they knew I wasn't going away. And I made that very, very clear.
They knew that you had enough, that you were going to go down a path, and that they were better off to make sure some of these things were accurate completely, at least, I'm guessing.
That's exactly right. I didn't say that overtly, but I over and over again left that impression that better that I write it than someone else. Someone was going to write the story, I said to them. Jim Simons' story, be it while he's alive or after he's gone, be it while you guys are alive or after you're gone, someone's going to write it. Better it be someone who cares about accuracy. And I do. I can't tell you how hard this project was. There were endless days where I was sending just short paragraphs that you wouldn't even notice as a reader, 4 paragraphs about mathematics back in the 70s and what Jim was working on, or something, some drama in the 80s at the firm. And I was sending it to people that are familiar with the information, and they'd say, and at first it frustrated me, irritated me. These are mostly mathematicians, and they'd say, I'd send them 4 paragraphs. Greg, this is awful. Greg, how can you write this? This is terrible. You got it all wrong. And then I'm taken aback. I've been doing this for a couple decades. I didn't think I got it so wrong. And then we'd go through it. I don't know, 10% of it would be wrong. And that's kind of why I sent it to you guys, to go through it with me and tell me what's wrong. We all aren't thrilled with errors. They hate errors. Like this mathematicians, it's a whole different breed, I learned. Eventually, I stopped taking it personally. I kind of was amused. This is awful, Greg. This is terrible. Well, what do you like? What didn't you like? Look at that second line in the 4th paragraph. You cannot describe differential equations that way. Okay, how would you describe it? And they would describe it. And I'm grateful. They spent a lot of time going back and forth with me. So I think, like the outsiders, the people on the inside and people that used to work there, didn't want this to be inaccurate. They figured, all right, Zuckerman's not going away. Zuckerman's going to write this thing. Let's at least help. We're not going to give him the secret sauce, but let's make sure he's accurate about what he's writing. And then, frankly, yeah, they're poker players, but sometimes the secret sauce slips out. There were times when people told me things and they regretted it. You can't tell personally who said what, but there were those cases. I believe I got enough. The readers will tell me if I got enough.
It's a great feeling as a writer, though, isn't it? You're in the middle of something and then something slips out and all of a sudden all the pieces come together in your mind. You're like, yes, thank you.
Yeah, there were
a lot of that.
There were great moments in the process. There were awful moments. There were frustrating moments. There was a moment when Jim Simon's person says, Greg, Jim decided not to talk to you. I'm sorry. And that was it. I was like, how do I really write this book about Jim Simons if he's not going to talk to me? It's about his firm. It's not a biography. It's a lot of biographical stuff in there. It's really about how this group of colorful characters figure out the market. So there were awful moments. And as you suggest, at the beginning of the book, Nick Patterson, who played a really interesting, important role early in the firm, he said, Greg, no one is going to talk to you. And I remember sitting across from him in a restaurant in Cambridge, Massachusetts, saying to myself, how the heck am I going to write this book? He's right. Nick is right. They've got zero incentive. These guys got rich by working there. No one wants to piss off Jim Simons. So why will people talk to me and what am I going to do? So there were a lot of ups and downs, a lot of drama behind the scenes, and hopefully it was worth it for the reader.
So I'm curious, how many hours did Jim give you? Is there anything you might like to share in terms of personality or manner or just something inspiring that he gives off that other people could take away as a distant lesson from a guy that's as accomplished as he is?
He spent over 10 hours with me in his office talking about not Renaissance per se, but his early life, his more recent years, which are interesting in their own right. We talked about mathematics. We talked about life, approaches, things like that. I have to say, I'm a cynical journalist. I look for flaws to some extent. He's got them, like we all do, but he's a pretty impressive individual. I really think he's one of the more remarkable just individuals, personalities of the past 100 years. Again, his accomplishments in mathematics and code breaking, recently in philanthropy. He's a good guy. He's very unique because he can do the math, needless to say, and he's a quant, but he's also, you could have a beer with him. He's a funny guy. Some of the humor I think comes through in the book. I hope it does.
You mentioned his math. Not you mentioned his math, obviously his math, but I was thinking of his father. You mentioned his background and did not lead with a father with a high math background or anything like that. But does Jim attribute his math ability? How does he view it? Does he view it as just purely hard work? How does he see himself? Because again, he's got math that us mere mortals, we're just not going to comprehend in our lifetime. So how does he see that he made his way through at least the topic of math?
I don't know if I have a good answer. He developed this early love for the subject, for the topic. He was encouraged by his parents to pursue it. They were bright people. They weren't math oriented, though. I don't know. It's a good question where his passion and his abilities came from. Were they inherent? Did he work? Listen, I know he considers himself to be not the fastest mathematician. And he went to these top schools. He dealt with the top guys. There are people that are faster and quicker, he says. He's just very good. I'll talk about it a little bit in the book. He is really good at mulling a problem and sticking with it and being persistent. And you see that in the firm as well. There were ups and downs and they stuck with it. So he has an ability that maybe others don't. He chews on a problem for years sometimes in mathematics. That's one of his gifts and competitive advantages, I would argue. He comes at things also a little bit differently. He's got a different approach to mathematics than some in the field. And once again, that's similar in the world of investing too. I mean, it's ironic. There's a real paradox at the heart of my book that it was a guy in a group of people who didn't really know much about investing who conquered investing. And to some extent, I'm not saying he's an outsider when it comes to mathematics, but he does take different approaches to solving problems, and that's all helped him.
As we wind down, I got a couple more topics I want to run you through. If I take you back to the summer of 1998, for those that were alive enough to remember. It was a pretty crazy time. It was another one of these times where they said, if you don't trust the men behind the curtains, the government officials and the big banks, the world is about to go to hell in a handbasket because this hedge fund somewhere up in Connecticut basically blew up the world. And we're talking about long-term capital management. How did that affect you? Because that would have been a peer of his at the time. Probably much more money under management at the time would have been for LTCM, I'm guessing.
Yeah, LTCM was bigger, especially with the leverage. They were, I wouldn't call them quants, but they had a lot of similarities with Simons and Renaissance were doing because they hired academics and they hired often mathematicians, sometimes scientists. They hired from Wall Street, which is different from, in addition to the mathematics. So that was different from LTCM. Renaissance and Jim Simons don't hire individuals from Wall Street with any Wall Street backgrounds. But yeah, they were concerned. LTCM had models of their own and they didn't work. And so they learned lessons from that experience. One of them being, be humble, don't leverage up so much, don't be stubborn with your models. LTCM was a little bit stubborn. The Renaissance gang and Jim Simons in particular, they do not override their models 98% of the time, 99% of the time. And that's one of their skills. That's one of their explanations for their success. But once in a while they do. And it's usually Simons over the protests of his colleagues. And I write about it in the book, where in crises sometimes he will take risk off, even when the opportunities look great. So if you remember what happened with LTCM, because of what was happening in Russia, market was flipping out and LTCM stuck with its positions and moved into them a little bit more, added to them. And that's not what Renaissance does. Even when they see real great opportunity, they'll reduce risk in a period of crisis, and then they'll jump right back in when their models say to. They learned lessons from LTCM were the answer, I would say.
I have one last question to you, but before I get to that, how would you define their strategy in terms that the average person comprehends? Is this a form of arbitrage? Is it a short-term momentum, kind of a cross-sectional momentum? Was there ever any real definition given to the strategies or the structure that they have determined and the way they go about it is just different than everyone else?
Early on, I think, until around 2000 maybe, a little bit before, maybe after, you could actually see them as cousins of technical traders, technical analysis.
Using price movement.
Exactly. All about price as an input. And that's what they focused on, looking at patterns, looking for patterns in the market. So that's not unlike what technical traders do. And I give that analogy and I talk about the history of technical analysis just a little bit in the book because I think it's important. That's how people within the firm describe themselves. Maybe you and I would be a little bit surprised by that because I think the general view of technical trading is that it's really unsophisticated and people dismiss those individuals. But there are some really impressive traders on the street, Stanley Druckenmiller and others, who use technical analysis sometimes to confirm a thesis. You got to look at them as a much, much, much more sophisticated version of technical trading. That was early on, or that was till 2000 or so. And then they started collecting other kinds of data, everything from the stuff that we call today alternative data. They are a data machine. They just know Bob Mercer, who played a huge and still plays a huge role within the firm, controversial politically, but he talks about there's no data like more data. So they vacuum up. If there's a piece of data you can think of a possibility, they bought it before everybody else, and they've been analyzing it before everybody else. Now you can look at them as early machine learning because their models work on their own. They don't even know really why their stuff is doing what it's doing, their trades, their signals, why they bought it, why they made money, that kind of thing. They can figure it out, and they do figure it out. But now you can look at them as sort of an early version of machine learning.
By the way, as you just mentioned, Bob Mercer, so you can talk a little bit about him, but I think it's interesting, this very prominent individual inside Renaissance basically helped to support Trump to get Trump elected. And Jim Simons was a big supporter of Hillary Clinton's. Such an interesting thing that inside the firm, you could have such a diametrically opposed political views inside the same shop, playing at the presidential politics level. It's amazing, huh?
There are all kinds of lessons, I think, from the Renaissance story. There's the investing, obviously, lessons, management lessons. There's also just lessons to how to work with each other. In this day and age, especially in the United States, when everybody's at each other's throats, you have Jim Simons, a left-leaning guy. I think he was the third largest financial supporter of Hillary Clinton in 2016, working with the co-CEO at the time, Bob Mercer, who may be the most important reason why Donald Trump's in the office, because Bob Mercer and his daughter Rebecca Mercer helped put Kellyanne Conway and, more importantly, Steve Bannon in the campaign. They settled it. They turned the tide for Donald Trump. Bob Mercer is a very right-wing guy. The firm is a mix. They got libertarians. They got all kinds of individuals. Now, what Bob Mercer was doing did eventually hurt morale within the firm, and I describe the scene where Simons had to come to Mercer and tell him he's got to step down as co-CEO. But they did work together for a long time, and despite the political disagreements, they're fascinating just characters within the firm and people who have worked there. That's the one thing that I was just overjoyed with, that they're not just kind of boring mathematicians. There's passion within the story, the Renaissance story. There's intrigue. There's all kinds of twists and turns that I hadn't expected.
My last one for you, Greg. Typically, this is the kind of question you would start an interview with, but what the heck was the trigger for you exactly? When was the trigger? What was D-Day that said, I'm going this direction?
2 decades ago. Who doesn't want to write about Jim Simons? I've been thinking about it in the back of my mind. I reached out to them at one point to work with him. This is years ago. I don't know, 10 years ago, maybe longer. Yeah, it's about 10 decade probably. And they were like, yeah, no, Greg, no, sorry. He's not working with you. He's not working with anybody. No. And we'll let you know if he ever decides to write a book. I've always kind of wanted to. And I remember being at a dinner and there was a quant guy there. And I was thinking to myself, I don't even think we were talking about quant stuff, but I remember looking at him and thinking, geez, that's the one story that hasn't been told on Wall Street. Wouldn't it be great if I could be the one to tell it? So then I started working on it. I got a book contract. I didn't cash the book contract. God knows I could have used the money.
When did you start the project with the publisher?
Late 2016, maybe early 2017. And then for 4 months, I'm sitting at my desk right now in my basement in New Jersey, and I had this check on my desk, and I wasn't going to cash it because I wanted the ability to give it back to the publisher. And I knew if I cashed it, I'd start spending it. I wasn't sure if I could do this project. And again, if I cashed it and then decided not to do it, it'd be a mess. I just didn't want it. And eventually the accounting department, Penguin Random House's accounting department, had this discrepancy. They wrote, what author doesn't cash in advance? It's not a lucrative business we're in. We could use the money. I got a kid in college. I was being stubborn. I wanted the ability to give it back. So I spent like 4 or 5 months working on the book without knowing if I could do it or not. And then I went out to California. I met with Elwyn Berlekamp and I met with Sandor Strauss. They worked with Jim early on at the firm. They were really fascinating individuals, but B, they were just interesting and colorful, and they had drama in their lives. And I said to myself, you know what? The early part of this firm, I think I can write about. It's just an interesting, fascinating group of people. They described other people Jim Axe, who had died. And I said to myself, okay, I think I can do the early part of this period, even if Simons doesn't talk to me. And then I'm going to make this giant leap. I really felt, and talked to my wife, I just still was never 100% sure I could do this thing. But I made a bet that I could fill in the gaps. I could do post-1990. Up to 1990, in his early life, I thought I could find enough academics, mathematicians, people who worked with him, even if Simons didn't talk to me. But thankfully, he did talk to me, and thankfully, I was able to get people within the firm. That was my fear. How the heck am I going to get people who actually work there right now to talk to me? But you try hard enough, and this was the hardest thing I ever did. And if you knew the hours I put into this thing and how much I'm getting paid per hour, yeah, it's not a pretty picture.
Well, now listen, not to toot my horn or anything like that, but I mean, back in the day, this is over 10 years ago, when I did this book on the turtles, on a smaller scale, I had these similar kinds of things where you're digging and you're digging and you're digging and there's no one talking to you. And then all of a sudden someone just says, oh, by the way, did you know this? Da, 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 da. And then you're like, oh my God, you got to be kidding me. And those kinds of feelings. So look, there's lots of people that have a podcast, but I do relate to so many things that you had to go through in this book. I think it's pretty damn awesome. Really, it's quite an achievement to go dig around in one of the perhaps the most secretive fund in the history of mankind, and to go dig around in there and to put a story together. Congratulations.
Thank you. I'm still stunned I finished. Forget about whether people buy the book or not. And I hope they do. And I hope they enjoy it. And I hope they stay in touch and give me constructive criticism and things they like, things they didn't. I love interacting with readers and listeners. But yeah, I'm still a little bit surprised that I actually finished it.
The book, The Man Who Solved the Market, how Jim Simons launched the quant Revolution, available everywhere. If they can't figure out where to get it, they don't deserve to buy it. Where can we send people? Is there a website or anything you want to direct them to reach out to you, give feedback, anything?
So I'm on Twitter. Feel free to reach out to me there. I think it's @GZuckerman. But I'm also at the Wall Street Journal. Feel free to email me privately, gregory.zuckerman@wsj.com. I love interacting with people. I get good story ideas, next book idea. Some of my best sources on Wall Street are people that ripped into me. You don't have to rip into me, people, but feel free to send me constructive criticism and things you liked and things you enjoyed in the book.
But please, after listening to this interview, do not write Greg an email and ask him how Jim Simons trades.
You can ask, but I'll send you to the book.
Good deal. Hey, Greg, thank you for coming on, and hopefully we can catch up for the next book because a guy like you has always got another one coming.
That was a lot of fun.
Wes, momentum. When did momentum, the idea of momentum, and you're going to need to explain it some from your perspective over the course of this episode, when did momentum hit for you? When did you go, oh, markets, trading, momentum, when did it hit? When did you know it was something?
Well, for me, just to step back a little bit, I start off with a formal brainwashing and value investing. So, I was a Bible thumping, Ben Graham, intelligent investor. And if you've ever read that vein of literature or books, momentum, technical analysis, this stuff you're insane to believe it. And then when I was doing my dissertation at Chicago there, we have to read the papers, and I read Jagadish and Titman 93, and I was like, holy cow, all this brainwashing I've had that you can't just use simple price signals to predict future returns is just factually incorrect. So for me, it was honestly just being introduced to the data and the research that for whatever reason I just hadn't opened my eyes to, because I was kind of in that cult of value investing and efficient markets. That was it, JT 93.
So that's interesting. So if I was to offer a comparison, as I have far less education, I did not go down that path, and I kind of came at it from more of the trading track record standpoint of the practitioners in it. So when you hit across the academic work, were you were just literally taken in by the academic work that momentum exists at that moment in time? Had you had a chance, or did you quickly find the chance to see how this worked in the real world?
For me, it was, again, it's all about how you get framed through your life and investing. And I got anchored really early, literally like when I was like 12, on the whole value thing. So you probably know this studying psychology is once you kind of view the world in a certain way, you just avoid everything else, even if there's a ton of evidence or you see all these people making, tons of profits doing it. That's your religion. So that was my religion. And then for me, is literally just the research and the data was overwhelming, and it was totally independent of paying attention to practitioners. Because at the time, I really wasn't into wanting to be like a practitioner. I was, prepping to be a professor, working on, quant finance stuff. And then only after the fact here, like literally the last 5-10 years, where I've gotten a lot more involved, or, read books of yours or listened to your podcast, where you start to realize like, holy cow, the academics were clearly late to the, late to the party here. And so that for me, it's just, frankly, I was just blind and naive to the practitioners that were highly successful out there.
Yeah, it's the thing that was striking me as I was going through your work, and a lot of other people, a lot of, smart folks from the academic worlds that have put down the momentum recipe, so to speak. And then I always notice, because I'll go through footnotes and endnotes, and I always notice that there's there's very extended academic references. But I just sometimes think, my gosh, it's like all of these particular practitioners, and we don't need to name names right now, but we all know them. They all seem to be left out of the equation. And I one day wonder if there will ever be this connection of the two. I think, for example, Cliff Asness, through his trading and his work, has kind of connected the two. But there's all those people before Cliff that actually laid the foundation as well.
Yeah, no, for sure. And one of the things being in both worlds, and Cliff and I in many respects are clones. He's just a lot smarter. Like he was a Wharton undergrad, I was a Wharton undergrad. We went to Chicago PhD, he went Chicago PhD. Eugene Fama was my advisor. like we're kind of like these clones. It just, I'm, a little bit farther removed than him from, time. But I think what happens is when you're in both worlds, it finally becomes clear to you that both worlds have blind spots. So if you're in academic world, your focus is not really to make money. Your focus is to write research that gets published. And sometimes those are in alignment, but a lot of times, your audience of who's going to be your peer reviewers and who's going to publish your research could really, they don't care like if this makes money or not. And frankly, if it could make money, you probably won't get it published because it wouldn't be in line with kind of efficient market theory or what have you. So you kind of got that world. And then you go over to the practitioner world where it's only about making money. And a lot of times it's only about selling. So, their incentives are to sell and sometimes try to make money, but oftentimes just trying to sell, which means the research and the techniques are, I would say, a little bit more aggressive and not as conservative. So you have these two worlds. And for whatever reason, over the past 50, 60 years, like maybe DFA and AQR have cracked the nut on how to combine the two. But I think it's just a cultural divide that'll probably be around for a long time, I imagine.
You just mentioned Eugene Fama as your advisor, your PhD thesis advisor. Speak to the good professor for a moment, because he's got some controversies surrounding him. And I always want to let people explain. I mean, I have my perspective. Maybe it's a simple perspective, but, and I know he likes to take strong stances. But for example, I've seen him say some things about, for example, something simple like a moving average. And he just, unilaterally dismisses it. And try to unpack that, because here we have a guy who is really considered one of the grandfathers of modern finance. He's got his Nobel Prize. But when a simple guy like me sees somebody dismiss the concept of moving average, is there more going on behind the scenes that he's reducing to that one statement in his thought process? Or does he really think that this stuff just doesn't work?
So here's what I would say. So this will be a bit long-winded, but it'll be important because I think there's a lot of nuance here, because people have public personas and people have private personas. You can be different people depending on what persona you're taking on. So Professor Fama, I still would never call him Gene because he just kind of feels weird. I probably could. He's asked me to do that, but let's just call him Professor Fama still. One of the things that guy is just a workhorse, total stud. Love him. He helps people. He would take the shirt off his back and give it to you. So none of this is about him as a person. He's a great dude, and I'd do anything for the guy. So let's put that aside. Let's talk about how he thinks about things. Well, so in private sessions with the guy, like one of my dissertation chapters was literally highlighting that stock pickers on this club called Value Investors Club, which I just literally read 4,000 stock ideas from these hedge fund guys, did all the quant analysis and said, wow, these guys have alpha, or it seems like they do. And, and he agreed. He's like, yeah, you did the data right. And you're right. These guys seem to have stock picking skill, but in the grand scheme, does it really matter? Because you're talking about a small segment of players that aren't controlling tons of capital. So my theory about the trillions and trillions of dollars in the markets as a whole is still a theory that stands on its own 2 feet. So if you talk to him in private conversation and you're providing good research that's done in a reasonable, sound way, he's not going to disagree with the results. I think what happens is you get these little nits on the efficient mark hypothesis, and you and I would probably argue that there are a lot more than nits at this point, but I'm just giving you, I think, what his perspective is. Okay, so you guys find all these one-off deals because you're all data mining, and just by nature you're going to find a lot of one-off deals by data mining. But in the end, the big muscle movement that prices are generally efficient, markets are highly competitive, is still the overarching theme. In private, there's the nuance of, yeah, I agree with you, but I'm still right. And then you move to public domain. And in the public domain, you don't have the time or the ability a lot of times to tell nuanced arguments. Just like in politics, you can't give a convoluted argument because people will miss the point. They'll think they'll go off on, tangents. So in public, you kind of just stick to a notion and keep beating that drum because that kind of reflects your overarching view. And what happens there is a lot of times, and I've seen them do it, someone will be like, well, what do you think about momentum? They'll be like, it doesn't really matter. I just don't believe it. And it does feel like very dismissive. And I think in his mind, if you were to talk to him in private, he'd be like, yeah, I agree. This is really kind of anomalous. And we really just got to understand a little bit more. Overall, I still feel I'm right. That's like the private answer. The public answer is, nah, I don't believe in that stuff. Like the efficient market hypothesis is still a gold standard. Or that's what I think is going on. He's almost like a politician who's got to promote his big idea, and it's much easier to just dismiss things in the public and just stick with the same idea, because otherwise you risk that people may not even understand what your point is. So I'd argue that's kind of what is maybe one aspect of what's going on there.
I took you on the FAMA tangent, which is good. I think that's a great explanation for people to ponder. Let me get you to circle back, though, what I was originally bringing up, which is momentum. Let's talk about momentum. From your perspective, you have to sit down with somebody for the first time, and you're in the investment management space now. How do you bring up momentum in the face of, for example, Eugene Fama and Warren Buffett? Momentum just doesn't seem like something that fits very well. Now, from my perspective, I look at the evidence that I've looked at and I say, oh, wow, this guy, for example, and this is just a one-off example, but this guy, Bill Dunn, there's something here, this 45-year track record, there's something here worth considering. It doesn't mean it's all right or all wrong, but there's something worth considering. Speak to the idea, though, when you first sit down with someone and they've got the efficient market hypothesis in their brain, and Buffett has some things to say about that, but talk about momentum and introducing it to first-timers from your perspective.
Sure. Momentum can mean so many things to so many different people. What we talk about specifically in our book, Quantitative Momentum, is stock selection momentum, which practitioners know as relative strength. So there's a difference between relative strength and what people call time series momentum or trend following. What the hell is relative strength?
Relative strength be cross-sectional as well?
Yeah. Okay. Also, the geek term is cross-sectional momentum. And literally all you're doing there is the way that research works is you look at all the universe of stocks and you want to buy winners and you want to sell losers. Why? Because winners keep on winning and losers keep on losing on average. So that essentially, relative strength is the term for it in practitioner land. Cross-sectional momentum is like the geek term in academics. And we just label momentum, but you could also label, a lot of people label things like trend following momentum as well. But that's what we're talking about here, just buying winners.
Is time series momentum from an academic standpoint, is that purely trend following as I would understand it?
No, so the difference is the way academic research does it is relative strength is comparing at the same point in time the performance of multiple assets and wanting to be long the winners and short the losers, where time series momentum or equivalent, you could call it trend following, is looking at a single asset over time and comparing how it's doing now relative to how it was doing like a year from now.
Is time series momentum from an academic perspective the same as I would view trend following CTA managed futures? Is that the same, or is there more nuance there that I don't?
No, I think they're basically the same. And that research is starting to come out. There's actually a paper by Toby Moskowitz and some of his buddies over there at AQR. They published in JFE, Journal of Financial Economics, which is a pretty big time academic journal. And it's literally called time series momentum. However you define it, you want to do long-term moving average rules or literally compare like the past year performance to bonds and do it like absolute momentum or time series momentum. It doesn't really matter, but the research is starting to highlight, holy cow, this works. And that was published in 2014 when, I don't even remember when you wrote Trend Following, but it's probably a lot earlier than that.
Or when did Ed Seykota, Bill Dunn, and Richard Dennis first start trading? A few years before the academics got onto everything.
Yeah, you guys. So they're about, I'd say, 50, 100 years behind on that. And even on relative strength, which we found this out, after writing this book, is, my exposure to momentum was Jagadish and Titman 1993, which in academic literature is the quote unquote start of when momentum was founded. But when you start looking back, like, holy cow, there was like 30 years prior to that, someone like this guy, Robert Levy, basically said the same exact thing. You go back 50, 100 years before that, authors have said the exact same thing. You go back 300 years, and we talk about De La Vega, he says the same thing. So it's one of these things where you start digging in and you're like, wow, this idea of momentum, specifically like relative strength, this is not a new idea. It's just academic research is finally catching up, probably because the data is much more available and robust to actually, make arguments that, get published.
Let me shift you on this momentum for a second. So I see we've got from an academic perspective, I see the time series and the cross-sectional. Mm-hmm. Okay. So from a practitioner standpoint, myself, I can wrap my arms around, obviously in a few books, I can wrap my arms around the idea of time series or trend following, and I can go find the practitioner results. Now, in the academic circles, the momentum is typically divided up into two equal parts. But in my mind, and I could be completely blind, I just haven't done the work, on the practitioner's side, is there the data, the results that on the cross-sectional momentum side, is there the data to hold a candle to the time series practitioner results? Or is it more just from the academic perspective, there's these two forms of momentum, but a practitioner's standpoint, they're not necessarily equal? Correct me if I'm wrong.
Yeah, got so big muscle movement, trend following, or time series momentum is it's really specific where you gain a lot of the edge in like your tail risk, right? So you're going to get to capture a lot of the trend, a lot of the upside, but you kind of rip out the huge face ripping drawdown. That is super robust. We've looked at it. I'm a total believer now. Is it hard to stick with? Of course. It's a great thing. Huge scalability. Very difficult for others in the marketplace to follow that strategy because a lot of times it requires you to do weird things. Got it. Cross-sectional stock selection momentum, I would say is very useful, but just by construction, in order to get it to work, it has to be really high turnover, and you got to do pretty concentrated portfolios, which means you're automatically running into scalability problems. And not everyone in the world can really be effective at doing stock picking cross-sectional momentum. And so the only people, frankly, that I know of that have actually even given a good faith effort to it, it would probably be AQR. They're kind of the guys I say put momentum, the stock selection momentum on the map. But what you'll notice with a lot of their strategies, because they're obviously massive and they have scalability where they want to jam a lot of money into something, they're not really going to be able to capture the true stocks selection momentum because they're going to have to closet index the thing because they want to be able to jam like tons of money into the strategy. So it's a very niche-y, I would almost call it boutique relative to trend following time series momentum, which is something you could deploy with a lot more capital. And so that's clearly like not a great thing about cross-sectional momentum, but there's always corners in the market where if you can add value and use research to improve the expected performance, why not? I wouldn't call it like a panacea almost equivalent like where you get with time series or trend, but that's just is what it is.
It's a nice perspective for me to hear because I know you're coming at it from a different world, so I get to pick your brain and kind of see what you have seen. Let's shift this into the why part. For example, we're talking about momentum. We're talking about these two types of momentum and the academic versus practitioner. What works, what doesn't work, the results. There's a reason why this momentum works, though, and I think this is, for me, is always one of the reasons I love to have the behavioral people on my show, is because all of the quant thinking is still rooted in us irrational monkeys, isn't it?
Yeah, that's what it should be. So you kind of have, there's another division within quants. Like, I consider myself a practical quant, and then you have quants that are just physics PhDs that just do machine learning, and they could care less about the dynamics of the market, the behavior of the market. So there are those types. They literally they're the classic, smoking a cigar, running their computer, data mining, and that's fine.
When you say that, are you talking about momentum strategies or just other quants doing kind of some?
So what I'm talking about is so what you have out there, and this is why we talk a lot about what we call sustainable active, because sustainable active is something that it's got to be rooted in some fundamental behavioral bias problem, and it's also got to be really difficult to arbitrage away. And we do believe momentum is one of those. But you also have another group of quants that don't really think about like the macro competition. They say, hey, let's just get the best computer, do the best data mining, we'll find an amazing result, and let's trade it. But the problem is, if they never understand, well, what's driving that benefit, and is it sustainable, and also why isn't the competition already doing this, those are always going to be fleeting trades or data mine trades. So momentum, viewed through the lens of how we look at it, how you look at it, is we want to understand, is there a systematic behavioral bias problem that drives this damn thing? And then secondary, if we're going to start trying to take advantage of these opportunities, we also understand, well, why hasn't it been arbitraged away? Because then we know if it's systematic because it's in monkey brain and it's hard to arbitrage, well, this is probably going to be sustainable over the long run. Momentum in particular is something where, I mean, you're obviously probably familiar with it, but yeah, it's definitely rooted to some extent in behavioral bias. And the interesting thing is there's actually competing arguments about why. Some people say it's an overreaction phenomenon. Some people say it's an underreaction phenomenon. And, the truth is probably that it's probably elements of both. Is that kind of what you see?
What I love, you've got this one little formula, and it's quite simple, but and you already kind of said it in one way, but sustainable alpha plus sustainable clients equals long-term success. Well, sustainable alpha, okay, you're talking about how momentum works. That works. But sustainable clients are asking the first part of the equation. Can sustainable clients keep up with sustainable alpha? I mean, if sustainable alpha is time series momentum, are there people that can actually stick with that? And if you don't have the client side, which is frankly, it's kind of this reflexive type thinking where sustainable alpha in time series is all based on the idea that people are monkeys. But for people to stick with it, they can't be monkeys. So if you're going to get long-term success, it's a conundrum, isn't it?
Yeah. And that's literally like the more and more I've been in this business and the more and more you study like success stories, and you could argue DFA is one of the best, right? It's not about being the smartest guy in the room, coming up with the most whiz-bang mousetrap of how to do value or momentum or trend following, whatever. What it's about is having iron will, discipline, because DFA, they've basically arbitraged away book to market, which is arguably the worst value metric, and it's very simple. But you got to ask, well, why are they so successful when there's people that have way better value models that, in expectation beat it? Well, DFA is successful. Dimensional Fund Advisors, just for the audience if they're unfamiliar with them, and they have $500 billion. And why are they so successful? Because they have brainwashed a cult of investors over the last 30 years to buy and stick with value no matter what. And because they've now coupled very sticky capital that's super disciplined with a strategy that is exploiting, of the value anomaly, which is also rooted in behavior, they've done a good job of basically eliminating at the margin the value anomaly, at least as measured by book to market. Now, there hasn't been a firm that's done that equivalent in momentum. And as you know, trend following in particular it all works. Like, we can go to every data set over every market. It's going to get you most of the upside, but eliminate like the huge drawdowns. It's just a fact. And it's the most robust thing I've even ever seen in my life. So why the hell doesn't everyone do it? Well, you're going to look like a total idiot over multiple year periods when you're always being benchmarked against buy and hold passive indices. And to the extent that there's not huge swaths of capital that has the discipline to stick to the damn thing, it's always going to be an opportunity for that small group that actually can do that. But I think human nature and the fact that people are born every minute, and most of us are not going to have that discipline, means these opportunities are probably going to always be around.
But both sides have to go through drawdowns. I mean, if you look at a data set for something like Big Daddy Omaha, Warren Buffett has got major drawdowns in his track record. So both sides. So are we really talking about that momentum is late to the marketing party?
It could be. The other thing is, it's not just about drawdowns, it's also about relative performance drawdowns. That seems to be almost more important than just absolute drawdowns, frankly. Because one of the things that makes Buffett's track record really interesting is he's had a lot of drawdowns that are on par with the market, but his drawdowns occur at different times, and so his relative performance drawdown, obviously like the late 90s, is totally insane, which makes what he's done even more impressive, because even though his drawdown profile absolutely is basically equivalent to S&P, it's his relative drawdown profile is absolutely horrific, and yet he stuck with it. So that's one point that I think is also important as far as like sustainability on clients, not just absolute drawdown, but the relativeness. Because
it's relative to what people have first anchored to, and if they first anchored to value, and then you throw them out something like momentum, and you try to tell people, hey, by the way, these are two sides of the coin. They're different, but the anchoring of being anchored to the value strategy first makes the getting momentum palatable is tough.
That's true. Yeah, 100%, especially stock selection momentum, because, just looking at standard deviations on like pretty concentrated portfolios there, you're looking at 25% vol estimates versus value, or the market's around like 15 over time. So yeah, you're talking about like the buck and bronco here, but of course, the upside, which you're way more than compensated for, at least historically, is way higher returns. But yeah, you got to stand by for some chaos, for sure.
Let me pick your brain a little bit about tails. So time series momentum trend following has this. It has many benefits, but one of the benefits it has is doing exceptionally well during tail events. And obviously, I still think, and maybe he would disagree with me, I'm not sure I want to get into a Twitter war with him because he would beat me. But Nassim Taleb, I still think when I look at his work, I still think time series momentum is one of the best examples of demonstrating black swan activity and how a strategy can actually take advantage of black swan activity. Speak to that, because that's a real benefit that I still think in this day and age. Now, look, you can't try to tell people, hey, you want to have this particular percentage in your portfolio to kind of give you a hedge on the downside. And we know the downsides are always gearing up to come at some unexpected opportune time in the future. But it's a real critical aspect when everyone's long. You can't stay right all the time just being long. And it's amazing to me after all these years, it's still that concept of a black swan and tail risk. That's really tough to get people to accept in this day and age.
Yeah, I totally agree. And I think trend following, managed futures programs, anything that's basically long volatility, these sort of strategies and asset classes, I think will always be underappreciated. And why is that? Well, because they only work once in a blue moon. And we have a situation like we have now where, everyone and their brother wanted to be a trend follower, be long volatility assets. And guess what? Managed futures, trend following, all those sort of systems have drug their feet the last, 8 years. And so now everyone says like, that's stupid. Why do you want to own it? And that's just because humans they're short-sighted and they can't think long-term. They can't think through the world actually does blow up sometimes. So yeah, I'm a huge fan of trend, and I don't know Taleb's specific angst against trend falling.
No. I'm not saying he has. I'm not saying he has one.
Okay.
I was just laying out time series momentum trend following as a great example of his work in action. The benefits of thinking like a black swan. Like a black swan.
You got it. And one of the things we highlight in our book and we've talked about in our own research, as this talks about as well, is time series momentum and stock selection momentum, they're not independent. Like stock selection momentum can give you an edge within stock exposure, but you have massive drawdowns. Well, you can now overlay time series momentum or trend rules on that, and you can get the benefit of the trend rules, but also be able to capture some of the extra benefit of like the stock selection thing. So yeah, time series momentum applied everywhere and anywhere is, I think, a great idea if you have the discipline to actually stick with those programs and you care about long-term capital preservation.
Hey, let's talk about some misunderstandings. Growth versus momentum. I'm still not sure I exactly even know what growth is. But why don't you talk about the misunderstandings, the confusion that exists between the two and help people to navigate that in their own mind?
And one of the challenges which you just highlighted is what is growth? What people have to do before they can even have this discussion is have a definition of what is growth. Well, academic research, because it has to be, objective and it's trying to, do studies, they define that. So growth is basically anything where a price to some fundamental is high relative to the market. So anything with a PE of 50 is going to be considered growth because the price is basically reflecting like, well, the reason it's so damn expensive is it must be the case that this thing has growth to it. So that's traditionally how it's defined. And a lot of times that definition of basically being expensive is correlated with growth portfolios. And what you'll notice in that definition is it is a price over a fundamental. Okay, that's growth. Momentum is strictly about price, irrespective of fundamentals. And that nuanced difference there matters completely. Because if you look at just the performance of growth, where that definition is just expensive crap, it's a terrible idea. Why do people continue to buy growth stocks? I have no idea. Now, momentum, where it's just defined by like relative price strength, and that's all you're looking at, independent of fundamentals, that sort and the expectation on buckets of securities with that characteristic do extremely well. Growth, to the extent that its characteristic is it has high momentum, works great. But growth, to the extent that it doesn't have high momentum, is a terrible bet. Whenever people say, oh, well, momentum investing is just growth investing, not necessarily, because a lot of growth stocks, if you're not considering price momentum, it's like the worst bet on the table out there. And a lot of people do that all the time. So it's that nuanced difference between...
Well, and generally also, when you have it's time series momentum, if you're comparing to growth, I'm assuming most growth investors, traders don't have a stop in place.
Yeah, exactly. They don't even have like a trend following type rule or anything. And how they look at growth, I mean, a lot of people do like, expected earnings growth rates over the next 5 years, all these other things. But to the extent that they're not focusing their growth selection on price movements, i.e. momentum, they're just shooting themselves in the foot, because people have studied all these other components that a lot of growth managers use or characteristics that they hit upon. And for the most part, they don't work. Like the only one that works, which sometimes is correlated with growth stocks, is strong relative strength. And if you just did that and you didn't do any other component of quote unquote growth investing, at least the empirical evidence is pretty clear, like you would be better off. And so I think that differentiation is really important for people that are trying to allocate their portfolios to growth. Really what they want is probably momentum, like the thing that offsets their value exposure. What they don't want is growth, where growth is defined as some price to fundamental or something else that's basically not momentum, which is what leaks in there a lot of time.
What is risk to you? What is risk?
Well, risk to me personally is the preservation of capital component. I can take volatility, i.e. stocks bouncing around, but, I can't compound on zero. Preservation of capital is, anything that prevents that is what I consider risk, which is why I'm a trend follower, why we probably don't disagree on a lot of things. But coming out of academic world, that is not risk. Risk is standard deviation and all these other, concepts that are mathematically convenient, and so that's just where a lot of the world in endowment space and modern portfolio theory has kind of been brainwashed to go towards, where they don't really consider or appreciate tail risk, which is the risk that prevents you from keeping your capital permanently.
You're probably a lot more clued in as you talk about endowments and institutional investors. And as we talk about risk, and risk could just be like, what's my potential loss? I mean, there's something very tangible and real, and you paint the picture that perhaps that many of these well-intentioned folks out there look at risk in a much different way, a standard deviation measure, and use the phrase brainwashing. Talk about you having to sit down with someone and remove that helmet they have on. There's that helmet that says, I'm anchored to something. I will not listen to you. Talk about the idea of persuading and getting someone to come over to your perspective on risk. Any stories that come to mind, or any perspectives that you can share?
Yeah, sure. So first, an understanding of why is that the case? Because I'm used to be a full-time professor and I still adjunct, and what it is when all professors, we all learn modern portfolio theory, mean variance analysis, which builds to the CAPM, and it's all beautiful. It's all got great PowerPoint notes with amazing lectures. It's all part of the CFA curriculum. And so the whole world, including me, because when you're a professor, you just teach what you're told to teach.
Hold on. What do you mean you're told to teach? Explain that.
It's like it's not like you're told to do this, but it's kind of like the culture and like the social pressure and the social norm is just, this is what you teach, because this is how we're prepping people to be quote unquote educated. So you teach those things, and I should do it too. Now, I was a little bit different, where I would always bring in the idea of, hey, there's these maniacs out in practitioner land like Mike Covel doing trend following, and you should also pay attention to them. But the core lectures, the core notes, the core lessons, the core activity to kind of get them to understand these basic concepts of modern portfolio theory, that's what you teach. And so to the extent that students are unable to learn that basic knowledge, which is important because you can only destroy an argument if you understand the argument, but if they just take that as gospel when they move out to the world, which obviously a lot of people have, because this is how everyone thinks, you're always going to start from that framework. So that's the reason why I believe that this mentality of kind of efficient frontier, plugging in your expected return and your volatility and your covariance matrix, and out pops your magical, investment strategy. I think that's why it's so prevalent. Now, the next question you mentioned is, well, okay, fine. Now that we know this is the psyche of many folks out there, how do we convince them that may not be the greatest idea on the planet? One of the things we do is we do a thought experiment. We wrote this paper about this where we say, hey, I'm going to take the S&P 500 returns from 1927 to 2015, just using, CRISP database. And we're going to just pop out the expected returns and variance and alphas and all this stuff. So the alpha is going to be obviously zero if you're looking at the value weighted market cap index, because by construction, it doesn't have alpha. The standard deviation is going to be around 15%. The expected returns, the CAGR's around like 9 or 10. Okay, great. Everyone's like, yeah, that's cool. We'll plug it in our model. We do a thing where we say, okay, here's what we're going to do. We're going to take that same time series, but in the last month, you're going to have 100% negative return, i.e. you go bust, right? you look at the same stats. What are the CAGRs? Or what is like the expected returns? It's not going to be 10. It's going to be whatever, 9.8. The standard deviation is going to be not 15, maybe 16. This is a bankrupt strategy here, right? Like, but mechanically, the expected returns, the standard deviations don't change. And then we say, okay, now let's look at alpha. So the alpha is still going to obviously be 0, but let's do another little trick. We're going to mechanically add into this, passive index alpha of 10%. How are we going to do it? Every month we're going to add 10% divided by 12 over the last 100 years, but we're still going to have that last month be negative 100%. What do you see? All of a sudden you have alpha estimates now too. You have alpha estimates of around 10%. Again, all of this is associated with a bankrupt strategy, and all of the metrics, expected returns, volatility, alpha estimates, correlations, blah, blah, blah. They're all saying this is a great thing and nothing's changed, even though it's bankrupt. And now you start getting people to think like, well, wait a second, all my tools that I use to make decisions aren't even accounting for the fact that this is like got tail risk. And so now you open up the discussion to let's think about drawdowns. Let's think about extrema events. And now let's think about trend following. Let's think about managed futures. Let's think about long vol. And all of a sudden, to the extent that they're entrepreneurial and they have the ability to think outside the box, they're open to it. Some people will be like, yeah, that's great, but that doesn't fit in our model, doesn't fit with our investment committee, how we've brainwashed them over the past 20 years, so we're still not going to do it. But at least for people who are open-minded and have the ability to change their mind because they control the money or what have you directly, now the conversation's like, oh yeah, good point. So that's kind of how we do it.
Are there some people that just can't shift? I mean, I understand the idea of career risk and they can't shift for that particular reason. They might say, no, we can't do this. And then when the meeting's over, they pull you aside and they go, God, that's really cool, but we just can't do it. There's that type of person. But are there some people that you deal with, in the competition, so to speak, on the battlefield, where they literally just look at you and say, no, this just doesn't work. And it's like literally that I can't even, it just no. Do you still get that?
We don't, because we present a pretty compelling case that's evidence-based, and anyone who's willing to talk to us is usually open
they've already
to evidence.
They've already passed the filter. They know you've got something.
They're not story-based people. Like, they really want to do what's evidence-based, and the evidence on that stuff is so overwhelming, you just can't deny it. And so, but there's also, one of the solutions, which is also equally wrong, is you say, okay, great, I'm going to do this for 1% of my portfolio. So, let's take managed futures. Like managed futures, that's like the ultimate like crisis alpha, long volatility asset, volatile as hell, looks like, it's horrific during normal times.
But we're just calling managed futures just trend following, essentially, because the vast majority of assets in managed futures are trend following.
Yeah, sorry. Yeah, managed futures in my mind means trend following across futures contracts. You got it. Long and short, right? So that basic construct, is long volatility. And so what do people do? They've got 90% of their risk in equity, which is tied to, if you go back far enough, like 85% drawdowns, and they're going to add like a 1% managed futures allocation. So unless that managed futures allocation is leveraged like 100x, if you're trying to balance your tail risk,
what's the point?
Yeah, what's the point? So that's, in my opinion, an equally bad solution to like say, okay, we're going to 99% stick with what we were doing. And yeah, that sounds pretty cool. We're going to do 1%. Well, that's
1% sounds like career risk too. Like, okay, we know this is valid. We need to put something in here that when everything hits the fan, we can at least say, well, we had a little bit.
Yeah. Exactly. Well, and the other thing is, in big asset markets, it's kind of like, when people move in the suburbs, they don't really care that they live in $1 million house and it's awesome. They care about the fact their neighbor lives in a $1.2 million house and he's got a fancier car. So just like in delegated asset management markets, it's not their money. They're just in the business. So to the extent that they're down 40 and their buddy's down 45, roger that, we're good to go. Whereas if you talk about trend and all these other things, now you got problems where the market might be up 20 and you're up 5. You don't, and it is that career risk thing. I think that is an overwhelming component because it's really all about relativeness in delegated asset management, not really about absolute performance. And that's just because, when you're delegated, you now need a third party that can help ascertain, hey, are you doing well? That brings in benchmarking. Benchmarking now brings in a framework of relativeness, not absoluteness. And now it just becomes really hard from an institutional behavioral standpoint to think in absolute long-term
people are
terms.
sitting out, people are going to be sitting out there listening. And when you have this much relative thinking that, you're competing with the Joneses, as you say, who's got the nicer car, it's by definition, Daniel Kahneman, irrational. It just doesn't make any sense. But I think if I'm new to this whole field and I'm listening to what you're saying, wow, what a ton of opportunity that exists, because if so many of the pros, the largest pools of capital are blind, are immovable, are the decision makers are all driven by career risk. For those people that are just starting out, what a fantastic opportunity if all the so-called smart people with all the money that you don't yet have, if they're all basically the crazy monkeys that Laurie Santos is examining up there at Harvard and Yale. My gosh, it just seems like opportunity 101.
100% with a huge if. If you have the discipline to stick to the programs and not succumb to the Joneses problem. And that sounds easy in theory. And, I used to be a stock picker, and I still have a capital loss from like a fraud I got stuck in personally. And that's kind of what, I ate my humble pie a long time ago. And I finally said, okay, I need to reinvent my life here and become a quant, do systems and focus. But, even me, I got a PhD in finance and I believe my own bullshit. And I knew about all this. And so it's like what Kahneman also says, where the guy who wrote the book that got the Nobel Prize on this stuff, he doesn't even trust himself because they're so powerful. What you're saying is 100% true. The opportunity is in front of all of our faces, but the problem is we all were born with monkey brain. So you need a way to deal with that problem. And to the extent you can, you're right. The opportunity is legitimate.
Let's theorize for a moment here. What are some of the potential ways that one can deal with this problem, especially in a world that I'm sitting here looking at two computers and I'm recording with you and I've got an iPhone in front of me. This information flow seems to be what keeps us to the relative teat, so to speak, and we can't let go because we're constantly comparing to everything. It seems like to me that if one is going to get to the point where you can have that discipline, there needs to be some removal from modern society, because if you stay affixed to modern society, I'm guessing the probabilities say you're going to have a harder and harder time to ever take advantage of the things that you're talking about on this show.
100%. And that's why Warren Buffett lives in Omaha. And that's why no matter how powerful or strong-willed you are, the more you're buried in the system, just through osmosis and subconscious like monkey brain problems, you will succumb to all of that stuff. And there's a great psychology finding where, and it also makes intuitive sense, where if you just feed people more information, they systematically become more and more confident in their estimate of their forecasts, but their forecast systematically does not improve. So with more information, more availability, all that happens is outcomes don't improve, confidence does. And that always ends up in a bad place. So a lot of people today make the argument like, oh my God, like everyone has a supercomputer. They can like trade a stock on their phone. They got CNBC, they got databases, they got programmers. It's all going to destroy and the markets are going to become efficient. But anyone who understands psychology, you think, actually, no. That's going to make people suffer from more availability, more overconfidence, and make more insane decisions where like the boring Warren Buffett guy who's following some stupid rule, in his underwear in a garage that is unattached to the world, he's going to now destroy those people.
Is that the guy that was the guy in The Big Short?
Yeah, guys like that. I actually went hunting with those guys a couple months ago. Yeah, that's what you need. You need to be wired weird, and you almost gotta to be anti-society to be a good investor, because the only way you win is you got to be different. Because otherwise, if you're the same, how the hell are you ever going to win?
There's an opportunity cost to listening to everybody too. The opportunity, if you're constantly fixated on what everyone else is doing, you need to be thinking that you are taking your brain and now attaching it to some other endeavor. Whereas if you quote, turned off the TV and then fixated on the problem alone, there's so much value in being alone. It's truly in a world, and this, I'm just kind of like brainstorming with you, in a world where extroversion is so celebrated, introversion has some real benefits in modern society.
I agree. And that's why a lot of the best traders in the world tend to have some issues, with their psychology, i.e. they're socially inept and they don't really give a shit what other people think about them. And guess what? That's an amazingly great quality as an investor. You cannot care about what the other guy has because he's just independent of you and you're just in your own little world here. In many respects, that's like a bad quality because you get social stigmas and all these other problems. But in investing, that's why all the billionaires are people like that, kind of weirdos. But because that's a trait that prevents you from, engaging in just, reckless brain damage.
Can I tell you one of the hacks that I've enjoyed in the last 3 or 4 years? So spending a lot of time in Southeast Asia, spending a lot of time in a country where I don't speak the language, it just starts to become white noise because I don't have to hear English conversations all day long unless I want to. Now I get my share of it. I stay connected to the world, but I've seemingly found my own hack to kind of disconnect a little bit from the sound waves, so to speak, because all that stuff just gets in our brain and ties us down.
Yeah, no, 100%. And the way I learned this, and I'll give you our hack, is I actually learned it from the Marines when I was in the service. Is the service and being in the military is a great psychology lab, right? Because you all of a sudden you're in a situation where someone's shooting at you, and your natural reaction is shit my pants, get on the ground, and cry and put my thumb in my mouth, right? And unless you train or unless you have something like hard-coded in your brain, some process that you just follow no matter what your monkey brain says, that's what you're going to do, right? So when you train like in the Marines, like when someone's shooting at you, your immediate reaction is shoot back with overwhelming firepower and run at the bullets. And that's not an intuitive reaction. So because normally you want to sit down and suck your thumb, but you have to train to that standard and that process where it's just automatic. The investing, again, going back to my days as a wannabe Warren Buffett stock picker guy, you're kind of in this world of I'm not following a computer, I'm not following a process. Therefore, I'm now following monkey brain. And so when something's happening in my stock, i.e. someone's shooting at me, my reaction might not be shoot back and kill the bastard. My reaction might be suck my thumb, which is probably the wrong answer. So now on my investing stuff, we do all this research. We figure out, hey, is this model the best or most optimized? Probably not. Could it be improved over time? Probably. But we don't care. We're going to have this model. We're going to follow this thing. And ironically, even though we don't want to be religious thinkers, we need to use religious thinking, because the good thing about religion is it forces you to just do stuff no matter what. But our religion is going to be this model that at least we know what the hell it's doing. And no matter what people say on CNBC, no matter what Trump says, no matter what the hell happens in the world, we're following this damn model because we think it's buried in human behavior, and we think it's hard to follow for the rest of the world. And that's just what we do. So that's how my hack is follow models like gods.
You just brought something up that I think as we wind down, I think is a great kind of side note, which you brought up the idea of being shot at, and then the response is to shoot back and run into it with overwhelming force. Just recently, in just the last couple of days, Tom Schelling died. and he won the Nobel Prize in game theory. And so when you say that, there is a lot behind that. And this is more kind of a life lesson. I'll let you expand on it too. But the idea of game theory is real simple, and it's kind of like bully on the playground. If, somebody walks up and punches you and drops you, even if you're half that size, if you don't respond in kind, the problems that will continue by not responding, just dramatic. And so the idea, and even like when people watch modern society, if they watch Vladimir Putin take a step, if there is not a counter step, you are now officially weak in international relations. I mean, the reason the Cold War worked is because there was bombers in the air 24/7 for 40 years with nukes. And it was force meets force. If you're not willing to punch back when someone punches you, and again, I'm just going on a life lesson tangent here and I want you to run with it. But if you're not willing to punch back when someone punches you, man, it's over.
Especially it all depends on your opponent, but in general, depending on what culture you're dealing with and what the problem is, like for example, like Arabs, we'll take an example. That culture, exactly right. If they punch you and you don't punch back, you're dying now, because now they're like, oh, we've got the upper hand. We're going to just totally annihilate you. But they're also a society where if they punch you and you punch back hard and fast and they know what's up, now you got mutual respect, and there's a much more even, win-win potential there. And some people, just depending if they're not exposed to, if they never got beat up or got in fights or dealt with the real people of the world out there, because they were in like the American bubble of like our amazing freedom and
safe spaces.
Safe spaces. Like, well, that's fine if you're dealing with people that also kind of understand safe spaces. Like, I'm a chameleon. Like, if I knew you were a person like that, I'm not going to be an asshole and like punch you in the face.
You give me a hug and stuff like that.
Yeah, I'll give you a hug and we'll all kumbaya, because I understand that. Yeah, you understand. But the problem is those people don't understand is they may not be dealing with guys like me that can relate to them, because I understand how their cultural viewpoint and societal viewpoint is. They may be dealing with people in the rest of the world, and I'd argue like a vast majority of people in the rest of the world are not safe space kumbaya. These people are survivors. They're tribal. Their life sucks, and they need to win. To the extent that you get a safe spacer who interacts with someone like that, and the guy punches them in the face, and they're like, "Oh, don't worry about it. Like we want to like take care of you." Now that other person, they're not thinking like, "Hey, this is like someone. I don't want to be a bully. I'll be nice to him." They think, "Oh, this guy's weak. I'm gonna whoop his ass," and they go after him. That's the problem. Like you gotta understand, or people just gotta understand that like the world ain't nice in a lot of parts of the rest of the world out there, and we're all competing at some level. You just and I think the problem is like with complacent cultures that got too insular and just needed safe spaces and couldn't have a thick skin, which is great. I mean, that's an awesome society to live in, assuming everyone was on board with that. But the problem is everyone ain't on board with that. There's Vladimir Putin's out there. There's people that actually want to kill you and kick you in the teeth, and I think people just need to recognize that that's just a fact. So
it hasn't gone away yet. It's not one sweet one world order out there. It's there's a lot of different players of different interests and competing agendas, and again, and all those things allow markets to move all across the world, and all these different cultural differences. I mean, look, you, myself, I just want to see markets move and try to imagine, as you describe these scenes, try to imagine any time in the next year, 5 years, 10 years, 100 years, try to imagine all these different human behaviors, all competing, all at different stages, different perspectives. Try to imagine somehow or another, everything just becoming efficient. It's going to be really tough.
Yeah, it's impossible. I mean, there's an old paper like the Gross and Stiglitz 1980 article on the impossibility of efficient markets, and it's even goes beyond just what you were saying. It's just the basic premise of markets is the reason people participate in markets is because there's incentive to win from all your efforts of information collection, understand your own psychology, being different, what have you. And to the extent that doesn't pay, because everything's perfectly priced, well, those people don't engage. And when they don't engage, the markets aren't perfectly priced anymore. So the markets are a great thing in the sense that they have equilibriums, and people that put in effort, people that are willing to be different, people that don't care about the Joneses, there will always be a macro equilibrium that you get paid for your efforts in engaging in that activity, because that you're helping make the market efficient. But it never can be perfectly efficient, or that whole thing breaks down. So I think you're always going to see chaos and craziness and, at the margin, inefficient prices.
Wes, I think you're at 4 books so far. You've got academic articles across the web. Your newest work is Quantitative Momentum, a practitioner's guide to building a momentum-based stock selection system. And that's available on Amazon, right?
Yeah, Amazon and anywhere books are sold.
Where can we send people? Also, you're on Twitter quite a bit. Where can we send people? What's your main website where we can send people?
Just alphaarchitect.com. Sign up for the blog. Our mission, which is actually genuine, is, we want to empower investors through education, because I just love this stuff and love talking with you and guys like this. So go on the blog and sign up, and we just talk research all day long.
Great stuff. No, I enjoyed the conversation. We had a lot of different areas. I think you put some color on areas I think that it's not often covered. This academic meets practitioner, and I think it's helpful for me to try and see. It's kind of like this parallel universe in many ways, and it's fun to try and connect the dots and build bridges, so to speak.
Yeah, you got it, and that's what our firm's all about. And I think as more and more people, because to summarize, academic researchers are great because they're very careful, they're very smart, and they're really trying to go for, I think, the truth. The problem is they're not dealing in a real marketplace. Practitioners are dealing in a real marketplace, but they have objectives to try to make money and do things quicker and faster because they're in a more high intense environment. So they don't have the luxury to sit back and pontificate forever. And if you could somehow bridge those two, where we put these great thinkers who are trying to find the truth, but we need to infuse that with a little bit of common sense here, that middle path, I think, is probably one of the better places to be in, if you can figure out how to bridge the divide there and talk amongst both worlds.
Wes, it was good chatting. Let me know when the next book comes out. I'm sure if you've done 4 or 5, more are coming. More are coming for sure.
Well, we'll see, man. I got 3 young kids, and writing books has put a lot of gray hair on me. So I don't know. We'll see, though. They say you do get addicted to writing books.
Okay, Wes, take care.
You got it, man. Talk soon.
My guest today is Ryan Holiday. This is Ryan's, I don't know how many times Ryan has appeared. No, he's appeared a handful of times. One of my favorite guests. Always brings fantastic insights. Today we're discussing his new book, Ego is the Enemy. I hope you enjoy this conversation with Ryan Holiday. First, let me say, I have to blame you for my Orson Welles addiction today. Going through YouTube, I specifically caught a clip, an 11-minute clip from 1960, him being interviewed by the BBC and asking him if he thought his success with Citizen Kane at such a young age was a bad thing. And I having gone through your newest work, I'm like, wow, spot on question. And his answer was really great. His answer was like, look, these opportunities don't come along. You can't force it. And, it came along early in my life. I'm thankful for it. I wish they came all the time. And Orson Welles is a character, but he was pretty humble about the answer. I thought it dovetailed perfectly into where you're going with your work right now.
I was really fascinated by him, too, because I'd always heard that he was very embittered by what had happened to him, that he made this amazing movie and it wasn't appreciated in its own time, and that he'd been so viciously attacked by the powers that be for making it, specifically the one power of William Randolph Hearst. But when I really read about it, and then I was reading about the eulogy that his girlfriend gave him when he died, that there really was none of that bitterness. In fact, he sort of took it all in stride as this sort of larger than life character who just sort of saw it all as part of this journey, I found to be very fascinating and very inspiring, because I'm not sure I would have necessarily had the same reaction.
It would have been tough. I mean, I've had moments in my life where so-called powerful people came at me, and it does knock you off your step at first, and you don't like it, especially if it's not fair, perhaps is what many might argue in the Hearst against Wells case.
Yeah. Or to make this when you pour yourself into a creative project, anyone that stands between you and that project reaching the audience that you think it deserves, that's where you get, because you're so possessive of your work and protective of what went into it, that's where the bitterness and anger and hatred comes in so easily. One, I guess I would ask, and I think this is what Hearst did, it's asking what that accomplishes in terms of actually helping you reach that audience. And two, these are things that in some ways you don't control. And so if someone comes in and attempts to attack you or screw you over or hurt you, are you going to let them ruin your personal happiness on top of that? And I think that's what Hearst managed well enough, and I found to be inspiring. Martin Luther King says this, right? He says, like, hate is too great a burden to bear, but often that's a burden that many of us bear willingly, and we carry around for us in some cases for many, many years.
And it gets back to, I think, the foundation of all your work so far, which is the Stoicism, as we might call the angry Buddhist. But yeah, I think having that foundation, and I know you aspire to have that foundation, I highly empathize and really seek to be there too. Because if you can just kind of let it go, that's so much of it. And as the Stoicism is like, look, imagine the worst case possibility. And once you imagine it fully, how can it hurt you?
Yeah, and I mean, to go to the Hearst example, if as a creator you take pride in the fact that you made something amazing, not how well that thing does financially or critically, then you're in a much better position, because these people can't hurt you the same way that someone whose judgment is suspended until the box office receipts come in is inherently much more vulnerable. So that's something I've tried to take with my own work, is that if I'm happy with the work that I've done and the book that I've created, not completely so, but if that's where the bulk of my judgment of what success is or isn't is in the product itself, I'm in a much more invulnerable and strong position, because then I'm, as the Stoics would say, I'm more indifferent towards the results. That doesn't mean that I don't want it to be successful, I don't want it to do well financially, but I'm less dependent on that outcome, and I can accept either.
As you say in your newest work, doing is enough.
Yeah, the effort's got to be enough, because I realized this when I was putting out my last book, is that basically it's you control the effort that you put into the work. You don't control the reception to the work at all, really. And that's a very hard place to come to, but it's ultimately a very freeing one. And, it was funny with Obstacles the Way. That's what I went into thinking. And when it came out, it didn't hit the bestseller list the way that I'd moved enough copies for it to do. Right. And so I had to tell myself, hey, the book is good. That's all that really matters. And so on the one hand, there I am sort of reassuring myself in the face of a disappointment. And then the book went on to do, 10 times better than I ultimately expected. But I had to tell myself the exact same thing. Hey, the book is what it is. You were happy with it. You can't be more happy with it just because it sold well. And so in that way, what Orson Welles is doing, and what I tried to talk about in the book, is that you have to be prepared to write off both catastrophic failure and mind-altering success with the same logic, that what matters is that the book is what it is, or the project is what it is, not what they would call externals, the things that are outside your control.
Let me take a step back. Let's start to break apart your newest work, which is called Ego is the Enemy. Great title. And I think there's three key parts that you've kind of divided the work into: aspiration, success, and failure. I'm going to let you talk a little bit about each as I weave you through this. Really nice in your preface, your opening, and you go into your own life some. I mean, you're not just a guy in this book who's saying, hey, this would be a great title to write about. There's so much interesting information. But it seems like you were inspired. You had to do this work based on your own life.
Yeah. I mean, I feel like all my books come out of my own life. I just prefer not to be in them because I don't like them resting on me personally if they don't have to, right? I'd rather the research and the facts stand what they are. But I had more of a personal connection to this one in that, and when I'd sold this book on humility and ego in early 2014, and then in late 2014, I saw, American Apparel collapse. When you watch someone that you respect and admire get thrown out of their own company, and then that company declare bankruptcy not long after it, you sort of go, how does something like this happen, right? And could something like this happen to me? And what am I doing that would contribute to something like that? So that's where my interest in ego sort of was taken to another level. But what I wanted to look at is sort of not, hey, here's some time when I got too big for my britches, or, I got a little delusional. I wanted to look at these things from a historical and a universal perspective. And what I found in the material is that, whether you're aspiring to do something, you're experiencing success or you're experiencing difficulty, ego is pretty much the worst variable you can introduce into any of those equations. It just offers essentially nothing constructive.
Your old boss, it seemed like, in the press accounts, and I remember seeing some of those press accounts and read several of the stories, and I thought of you. I mean, obviously it was not about you, but I knew there was a close association. And it sure seemed like, wow, it seemed like an ego that was on fire, out of control, and perhaps the ego had, consumed him.
Yeah, I think so. I'll tell you sort of what I found, and I think you've probably seen this with a lot of the traders that you have talked to. And actually, there's a line in Billions, which I'd love to know if you like the show or not, but he makes some boneheaded trade where he loses a lot of money, and the therapist is asking him why, and he says, when people tell you you're Superman enough times, you start to think that you are. And I think what happens is so many entrepreneurial ideas are legitimately insane, right? You look at American Apparel, it's like, hey, we're going to be the largest garment manufacturer in the United States. We're going to pay a fair living wage. We're going to make our own clothes. We're going to sell them in our own stores. They're not going to have any branding or logos on them. And t-shirts are going to be, $25. In some ways, that's an insane idea. It's a brilliant idea, but it's also insane. And so when you have an idea like that in any field, and then you make it a reality through your sheer force of will, one can be forgiven for starting to think that they have a superpower. Or when you have to ignore every single critic and doubter on the way to success, that becomes very problematic when you are successful, because now you've acquired a habit of not listening to the people around you. And they might have been wrong before, but that doesn't necessarily mean they're wrong right now. And so I think what you see, and what I've certainly seen in my own experience, is that really successful people get in this position where they've gotten used to just putting aside everyone else's objections or doubts. And what happens when those doubts are correct and are absolutely necessary, and you're just sort of plunging ahead despite all common sense. And that's where the person who built an empire is also the person who destroys their own empire.
Yeah, there's a very famous trader right now. I don't know him, but he's in the press quite a bit. A guy named Bill Ackman. He's involved with this pharmaceuticals company. And, they just released some congressional documents the other day. And, you start to read this and you're like, my gosh, this is the guy that supposedly has all the brilliance. He's made billions of dollars for himself. But behind the scenes, he's literally trying to jerry-rig and it looks like make up the fundamentals of the company. And I can't see how that will be good for him in the future.
Yeah, right. I think that's exactly right. In some ways, when you're aspiring to do something, that sheer force of will, if it's not a disadvantage, it can be somewhat adaptive, right? Because your creativity and it's manifesting itself as creativity and persistence and ingenuity. But then what happens is when you're in a position of power, now all of a sudden it sort of you're not the underdog, you're the top dog. And so it can manifest itself as bullying or fraud or criminal activity even. Like you look at someone like Nixon, he's this brilliant politician who's incredibly ambitious and hungry, but once he gets to the White House, he can't turn that off, right? He can't go, hey, maybe I don't need to win every single fight and I don't need to crush every single enemy. It becomes almost pathological, right? Like instead of going, okay, now I need to manage my success and I need to secure it, they're just striving for more and more and more, and eventually they put the entire edifice at risk.
I don't want to jump ahead, but you kind of talk about this later in the work, the canvas idea, which is letting other people win. And I think that's so hard. I was thinking about myself today with this podcast, and look, I'm always thinking, okay, I got to dial it back. I got to, But I think what I've tried to do with this podcast, and hopefully it's worked, is to bring someone on like yourself, many other people, and try and find a way to make that other person shine, to let that other person give that really cool insight or insights that they have and let it come across in a way that maybe they didn't say it before. And that's really my motivation for this podcast. That's what I'd like to do. That's fun to me. Yeah.
I mean, look, it's the same way in books, right? This goes to what you were saying. I'm in this book a little bit, but that was like a big fight for me. And it was only after getting a lot of feedback from other people that sort of made it clear that would be value additive. It's always easier as a writer to talk about yourself because that's what you know the most. It's harder for me. Like if I have a theory about something, I can tell you about how it happened to me at lunch yesterday, but it's much more work for me to sort of go back through history and find an unassailable example of that, and research it and write it up that way. But ultimately, I find that people relate to that more. And so in some ways, the Canvas strategy, it's selfless, but it's also very selfish. Like if you were on this podcast and you were dominating the conversation, one, I think it's less pleasurable for the listener, but it's also less pleasurable for the guest. And so you sort of realize, oh, hey, if I can take my own ego out of this and focus more on the joint project that we're doing together, then I'm going to be more successful in the long term. And I try to think about that creatively, but also as someone who started out very young, sort of in, I had a number of successful mentors. I'm in the same boat. It's like, hey, my job on the one hand is to learn as much as I can, to get as much as I can out of this. But ultimately, the way I'm going to do that best is if I help these people as much as possible, if I'm sort of seen and not heard. So you have to put your ego aside there. You have to say, hey, look, my job is to do stuff that my boss can take credit for rather than get as much credit as I can myself.
Let me give a few lines that I just love, little things. Ego is stolen, confidence is earned. It's the difference between potent and poisonous. It's poise, not pose. And speaking of great examples, and I know you love to go military, why don't you give a little bit of an insight as to why, and get as specific as you'd like. Why did Mr. Sherman, the great military leader, why did he make this work? What inspired you to include him?
Yeah, so I love William Tecumseh Sherman because I think in many ways he's sort of the antithesis of, say, like a Napoleon. There's the Napoleon-esque general who sort of always who believes that they are destined for greatness and that their life is this journey towards realizing that greatness. Sure, they did great things, but then they also did horrible things and ended their career in sort of disgrace and disaster. And then you compare that to someone like Sherman, who not only didn't believe that, who people not only didn't believe was destined for great things, he himself, I don't think, quite realized how great he could potentially be. And so one of my favorite biographies is B.H. Liddell Hart's biography of Sherman. And there's this passage where that line you just said is actually from. He's saying that, to someone like Sherman, his success in life was a sort of a source of constant surprise. It was this sort of gradual accumulation of skills and acumen and then ultimately success. And that made the accomplishments so much sweeter because he didn't feel, I don't know if you've seen this, but like when you hear these people that have this sort of certainty that they're going to do things, when they actually accomplish that thing, they find that it's disappointing. It's not what they wished it would be. But for Sherman, it was this almost pleasant surprise as he slowly accumulated this greatness. And Liddell Hart says it's poise and not pose. He's not faking it until he makes it. He's just genuinely living in the present moment and facing each sort of battle or opportunity or obstacle as it comes. And I find that as a model to be much more sustainable and much more emulatable as a person. It's, hey, I'm going to take each thing that I'm given and I'm going to do my absolute best here. I'm going to execute brilliantly in each different phase rather than, assuming that the world is crying out to hear my name. And so when you see someone like Sherman, who's probably America's greatest strategic general, I would argue that he was. You can maybe argue there's a couple people up there right there with him. He did this despite everyone's expectations, and I find that so much more impressive than say a General McClellan, who was the sort of the mind marked for great things in the U.S. Civil War, but was probably in practice one of our worst generals, and later became almost sort of like a Donald Trump-esque figure. I just found him to be very fascinating and very inspiring. It's more relatable, I think, as well.
One of the things you just mentioned that I think is so important, the idea of iteration, the step at a time. And this is not something that I think the vast majority of people that want to achieve, somebody's listening right now, and they want to achieve whatever they want to achieve in their life. But too many people don't understand that it's the baby step, build on top. You don't necessarily know where everyone's going to go, but you just have to keep stepping every damn day. And if you don't do that, and I would love for you to comment on this too, ultimately it seems like the vast majority of people are lost in this social media cacophony of like, look at me, I'm going to do something. But actually, you're not really doing anything if you're telling someone you're doing it all day long.
Totally, yeah. Like one of my favorite books is this book. It's called Working on My Novel. And it's just tweets of people talking about how they're working on their novel. And obviously they're not working on their novel or they wouldn't have sent this tweet, right? And I think the flip side of what you're talking about is what Nassim Taleb calls the narrative fallacy. People not only don't see it as one step at a time, they see it, so some people see it as chaos, other people see it as this grand story that they're living. And so they look retroactively, they look both forward and backwards, and they're telling themselves this story instead of facing each thing as it comes and understanding that, hey, it's going to go somewhere, but I'm not quite sure where. I think I'm working on this piece now. It's like we sort of tell ourselves these stories about how we planned this from day one, when in reality it was a series of consecutive decisions that happened to culminate in some event. But it is not, Google didn't set out to change the world. It's like these two guys are finishing their grad thesis. That's what they're doing. And it happened to turn into a company because they were able to spot an opportunity inside this project that they were working on. But it would be preposterous to retroactively give Larry and Sergey credit for creating Alphabet, right? Like 5 years ago, they had no idea it was going to become a holding company called Alphabet. And, 50 years ago, Warren Buffett had no idea he was going to be the world's richest man. But it was really about focusing on the individual decisions as they happened and doing them right that can ultimately create that, but it's not. I'm less convinced that one needs this grand, sweeping, bold vision for the future.
Well, yes, if we look back in time, and I don't say this in any kind of a negative way, just kind of a factual way. I mean, Google's success is based off tiny little ads. I think back to the infomercial in the mid-1990s for this guy, Don Lapre, who was selling tiny little ads to people. You know, the vast majority of Google's money came from that. They used the money to do a lot of cool things, but that was the factual start.
Yeah, right. It's a very practical nuts and bolts business that since they like, and so the problem with telling the story is not just that it's not honest, it's that you start to get consumed with the sweeping, sexy, fancy parts of things, and then you can ignore, you can go, hey, self-driving cars, that's going to be a multi-billion-dollar business, or Google Glass, it's going to be the future. And it's like, hey, remember when you guys made hundreds of billions of dollars with this, tiny, crappy ad software? And so you end up missing the things that are actually similar to what you've been successful with in the past because you're focused on these pie in the sky ideas that seem fun and interesting, but, historically have not been the creators of enormous wealth.
I love this great line. I want to read this from your book. It's really brief. Pride and ego say, I'm an entrepreneur because I struck out on my own. I'm going to win because I'm currently in the lead. I'm a writer because I published something. I'm rich because I made some money. I'm special because I was chosen. I am important because I think I should be.
Yeah, we love labels, right? Like the amount of people that I have told me, because I'll get introduced at parties and someone will be like, oh, this is Ryan, he's a writer. And someone will be like, oh, I'm a writer too. And I'll be like, oh, what have you written? And then it's like nothing, And I don't mean to say that like I'm a writer and they're not, but it's just interesting how people give themselves these labels as, I think in some ways, to compensate for the fact that the work isn't there. Like, I feel really, I've gotten to a point now where I guess I'm uncomfortable with someone calling me a writer, but like sometimes someone will introduce me and they'll be like, oh, Ryan's also an entrepreneur. And I'll be like, just because I have a business doesn't mean that I'm an entrepreneur. I think I think for the most part, that label is only giving me credit for something that isn't helpful to me. Do you know what I mean? It's making me feel that it's implying that I'm better or more accomplished in something than I really am. And so I think generally you try to avoid those things because they're not constructive to doing the work that you're trying to do.
Those things all attach to ego.
Totally, because the reason we're doing the thing, the reason we're starting a business or we're writing a book or we want to be called a writer or whatever is because we want whatever social status is associated with that. But if you get the status before you've done the work, in some ways now all of a sudden you have less motivation to do the work. And the work sucks sometimes. And you have to have a motivation for getting through that sucky part.
I think you planned it a little bit more on the writing than I did, but I was listening to Wells today and him talking, and the interviewer asking him about the various camera angles and whatnot. And he's like, look, we were ignorant. We didn't know. We didn't know we couldn't do that. I love that feeling. I love that feeling of not knowing what, just do it.
Yeah. Or I was watching Mark Maron's TV show a while ago and some person was like, ooh, what made you decide to become a writer? And he was just like, a book deal. And I think that's a much, more humble, productive answer than like, oh, I have these things inside me that I'm trying to get out. I think we can imbue the things that we're doing with a sort of self-importance and pomposity that makes the craft of the actual thing much more difficult.
One of your chapters, you were talking about becoming a student. And I thought this was great. I thought your example, a heavy metal example, was great. I had some familiarity with all of the names that you mentioned. In fact, I would be the guy that would say, I had a friend of mine that used to tell me how great Satriani was as a guitarist, but I couldn't stand his music. And I really never liked Metallica, but I did like Dave Mustaine's stuff once he left Metallica. So, but anyways, why don't you retell that story? Because obviously Satriani and Kirk Hammett, Metallica, these guys were top of the heap. But why don't you relay that story and why you thought it was so important to put in ego as the enemy?
Yeah, I was just always fascinated by the fact that Kirk Hammett, who's one of the best heavy metal guitarists of all time, was a student of Joe Satriani, who's one of the best sort of guitar virtuosos of all time. And I remember seeing that in a Behind the Music or something at some point, and I always thought it was really interesting. And when I was writing this book, and I wanted to tell a story of a really talented person who sort of continued their education anyway, I looked into that, and what I was so interested to find that, Kirk Hammett it wasn't like he was 17 years old and he sought out this guitar teacher and then they both went on to be famous. It's that Kirk Hammett was selected to be in Metallica. Dave Mustaine, who went on to found Megadeth, was the original guitarist in Metallica. He got kicked out. Kirk Hammett is chosen to be in this band that's clearly going places, that's already doing pretty well. And then he hires a guitar teacher. And the idea that it's like when you find out that Tiger Woods is a golf coach and you're like, whoa. Here I am thinking I'm good enough at what I do, and one of the best people in the world is seeking out a teacher. And so I love this idea of hey, I'm not good enough yet. I need to find someone who can help make me better. And you see that in Hammett seeking out Satriani, and they both did go on to do better, bigger and better things. But it was this student mindset that like, hey, I'm never good enough. I have to keep learning. I think is inherently a suppressant on ego. You think about it, it's like you're chosen to be in this amazing band, and then you attach yourself to a teacher who's so much better than you. That's inherently humbling, and it's inherently antagonistic to the ego because you can't sit at the knee of someone who is so much better and still, and have delusions about yourself. And so I think that's what Hammett got out of working with Satriani. And I've tried to, I've done that in my own life. I'm always trying to seek out writers who are better than me, clients who are better than me. I'm trying to surround myself with people that I can learn from.
I think that's part of the reason I keep doing the podcast is how else does one get the chance to just talk to so many interesting people that have, spent their life. That's what's so cool too, is I love talking to people that have dedicated their life to a niche. I mean, yes, we all want to be the polymath. We all want to have all this wide insights and whatnot, but the niche person, they just bring it. I love it.
Yeah. And then what I thought was so fascinating about, the Metallica story is that Dave Mustaine, who's kicked out, goes on to create Megadeth, and Megadeth is one of my favorite bands. I think they're amazing. But if you haven't watched Some Kind of Monster, which I think is one of the best documentaries ever made, here he is 20 years later, and he's still bitter and pissed off that he got kicked out of this band when he was like 20 years old. When you watch this, and he's laying out the case for how they screwed him over, and they definitely screwed him over, and he's so angry about it. Like, you could be, if you didn't know who he was, you could be mistaken for thinking that he was living under a bridge somewhere. But really, it's like he'd started his own band, he'd sold millions of records, he was rich, he was famous, he was all these things, but because he held on to this grudge, in the way that Orson Welles didn't, it nearly ruined his life. I mean, it nearly killed him. And it's not just, hey, how can we, stay humble so we can learn, but also how can we make sure that ego doesn't eat away at us and undermine the success that we do find.
Well, Dave's a great example too, and I think we could go further. One of the more popular, famous names would be Steve Jobs. These people that have had great egos and great success. So, somebody listening might say, hey, Mr. Holiday, what about these guys that have had fantastic egomaniac lives and they just, there's no control of the ego, but they still have massive success. You point out, though, you say, hey, hold on, let's analyze this a little bit deeper, and let's talk about the concept of outliers.
Yeah, I mean, look, I think there's a couple of things that these outliers prove to you. One, I'm not going to shy away from the fact that there are plenty of successful egotistical people, but as you know, correlation and causation are not the same thing. But when you look at someone like Steve Jobs, first off, I would say there's no dancing around the fact that he deserved to be fired from Apple. He was fucking awful, right? Like, he was unmanageable, he was unaccountable, he was crazy. he wasn't producing the results that he needed to produce. And so the board was forced to fire him, and they did fire him. The fact that retroactively he came back later and was successful does not mitigate or change the circumstances with which that original decision was made. And I think what's important to think about with Steve Jobs is the fact that he came back, that was not guaranteed either. What if he'd not done the personal work required? What if that could have very easily been the end of the Steve Jobs story, and the world would have turned out very differently. So I think all that, needs to be, it doesn't get its due. And then what also doesn't get its due is the fact that Steve Jobs remade his life post Apple. He started 2 other companies, one of which was Pixar. He clearly learned a lot. He didn't learn everything. He didn't improve every flaw in his personality, but he did address the most egregious parts of his personality. And so when he came back to Apple, ultimately, he was changed, not fundamentally, but enough that he wasn't his own worst enemy anymore. He wasn't a liability. He was the strengths far outweighed the weaknesses. And that's what allowed him to create the world's most valuable company, although it just got knocked down a little bit. But that couldn't, the Steve Jobs that was fired originally was not the Steve Jobs that invented the iPod and the iPhone and the tablet. Those are different people. And in many ways, the one became the other because he was fired and had to face some of those harsh truths.
And we're all interlopers. Whenever we're looking at somebody else's life, we can never truly imagine the multiple acts in their life. And when you're living, I think of myself, yourself, when you're living the experience, it's always different than the observer. The observer only sees bits and pieces.
Yeah. And look, I just tried to put myself in John Sculley's shoes. I would have fired Steve Jobs. Like, if you've ever been in an office that had a toxic, egomaniac in it, you do what you can because they're so talented. You try to work with them, and you try to make exceptions, and you hold them to a different standard. And it seems like, from what I've read, he did literally everything he possibly could. And they were all crying when they fired him. It was not like a decision they took lightly, but they had to. He forced their hand. And in many ways, we're lucky that he did that, because it forced him to face that truth about himself, which he addressed in some way. But again, that could have been the end of the story. That could have been, hey, remember, he could have been the cautionary tale that all CEOs are now told about, instead of the inspiring example that he ultimately became.
So if I move away from Jobs and I kind of get back to the idea of this iterative work, I think many people, because of things like the 10,000 hour rule, many people have started to understand, okay, I need to buckle down. I got to put a lot of time in. And you addressed this a little bit in your work. And I kind of texted you about this a couple of weeks ago, too, because I had a guy on my podcast who had done this original work, Anders Ericsson. And Gladwell kind of got this wrong. There is really no such thing as a 10,000 hour rule. And I think when people see this newest work of yours, Ego is the Enemy, they're going to realize that you're writing this book in the context of a bell curve and knowing about outliers. And so anyone that thinks, okay, yes, maybe Steve Jobs didn't go the right direction, things worked out for him. But on the flip side, if you just say to yourself, well, if I do 10,000 hours, that will be gold. That's all I need to do is 10,000 hours and it will all work out for me. That's not accurate either.
Yeah, no, it's interesting because Robert Greene in Mastery, he says it's more like 20,000 hours. And so I've seen people go like, is it 10,000 or 20,000? And it's like, it's not a number. It's just a lot, there's not like, you don't get an award when you get your 10,000th hour. It's somewhere on a continuum. And that's a pretty good estimate that the academics have come up with, and it's extrapolated out from some pretty narrow examples like chess and violin and some other stuff.
The goal is not 10,000 hours. The goal is the process you're going through to achieve some level of expertise or the achievement you're chasing. But I think sometimes these numbers are getting turned into the actual goal.
Yeah, totally. It might be 30,000 hours for you, or it might be 5,000 hours, really deliberate. Who knows? But the answer is that it's a lot. And the answer is, if you think it's a specific number, you're missing the point. It's the process that matters, the dedication to the craft. Again, for what a lot of us do, there is no end point, right? So it's like you take writing as an example, right? Let's say it takes 10,000 hours to be a master at this craft. That doesn't mean that that's the point at which you start making money from doing it. Perhaps you make money on your 100th hour, or perhaps you don't. You're a novelist, and it's not until 30 years in that your amazing work is finally discovered. So there's a lot of variables that matter a great deal that get lost in this simplification. And I think there's a certain amount of ego and entitlement in thinking, oh, okay, give me the number, I'm going to do the number, and then I want you to give me what I've earned when I get to that number.
I thought you had a great example with the ex-football coach, Bill Walsh of the 49ers. And I think there's just some great lines that I've written down here. Success or whatever it might be, it can't happen if you're convinced the world revolves around you. I mean, that's such a simple, but we're talking ego today. But why don't you talk about Bill Walsh's early success? Because a lot of people could look back in history and they could say, well, this was everything was planned. He was so meticulous. He was so detailed. But there's always variability. There's always randomness. I can think back to the first touchdown, well, not the first touchdown, but the touchdown pass from Montana to Dwight Clark, this very famous catch. I mean, that's a fingertip thing. I mean, it didn't have to go that way, but then we create the legend after the fact, but it's not necessarily, that's not the outcome is one thing. Again, back to what the whole concept, the whole idea of this work, the process is something else.
Yeah, I mean, I think what's so interesting about Walsh is when he took over the 49ers, he had sort of unprecedented control of the franchise. But one of the other, he was sort of he was focused on what he called the standards of performance, where these seemingly insignificant details, like coaches had to wear a tie, picture frames in the locker room could not be crooked, and you couldn't sit down on the practice field. And a lot of people resented this sort of micromanagement. And one of the coaches complained to the owner that Walsh didn't have a timetable for winning. And Walsh fired him because he didn't have a timetable for winning. And that this coach thought that was important, was missing the entire point of how he wanted to turn the franchise around. I think what I took from Walsh's book, he has an amazing book called The Score Takes Care of Itself. He has this thing, he's like, look, what a team does, the way one wins a football championship is that all the good teams are essentially even at a certain level. And somebody goes on a run towards the end of the season, and that run ends in a Super Bowl victory. And so what he thought is, I want to make a base camp near the summit, so then we could be in a position to make that run if the conditions align. That's his attitude towards success. It's not, hey, we're winning the Super Bowl this year. It's, hey, we're going to work really hard to be in a position to win the Super Bowl. And if the calls go our way, if the schedule goes our way, if injuries break our way, etc., this might be our year. And it just happened. He was humble enough to admit that it actually happened earlier than he thought it would happen. It happened in 2 years instead of 7 years, the way it might for other coaches.
I think one of the things that you touch on that I really love too is that Howard Hughes. It's there's been the romance of Howard Hughes, but when you get under the covers, you've got really an entitled weirdo who really didn't have much business success. He had a lot of freaking money, but I mean, you know what? I don't know what the hell we're supposed to learn. I mean, I've met plenty of super rich people in my life, and some of them you meet and you immediately go, wow, that person is inspiring. I can feel their intelligence. I can feel their hard work. And you meet other people that are freaking loaded and you just say, my God, they got lucky.
Yeah, totally. And look, I think Howard Hughes is I mean, you study this a lot, and what you do is the survivorship bias warps our perspective in such an incredible degree, right? We only hear about successful people because you can't hear about most unsuccessful people because they're not notable. What's so interesting about Howard Hughes is that because he inherited this company from his father, which had a near monopoly on the bits required for oil drilling, he was essentially able to fail like a couple dozen times it's not like even a Donald Trump who has like both a mix of success and failure. Howard Hughes was, I think you could say, like one of the worst businessmen of the 20th century in the sense that everything he was directly involved with failed, and the things that he handed off to advisors to run because he was bored or distracted were successful. And so in many ways, the fact that these other people were so successful was what allowed him to descend into this insanity and to be so perpetually unsuccessful. I mean, like, even the things that he was successful with, like, for instance, he made a lot of money in Las Vegas real estate, for instance. Can you really give credit to someone for spotting how valuable real estate in Las Vegas would be when they bought a hotel because they didn't want to move out of the penthouse suite and the hotel was trying to evict them, right? It's like, no, it's that an insane clock is right occasionally, you know? And when you look at Howard Hughes, you not only see this miserable person who died a horrible death, basically, a self-inflicted, you know, sort of decade-long suicide almost, you know, most accurately, but you see someone who he made one of his most successful business deals was TWA, which he was only forced to realize because investors kicked him out of the company via a number of shareholder lawsuits that required him to sell his stock. It's like, given a long enough timeline, he almost certainly would have run that company into the ground too. And so, you know, you see, we love mavericks, but we forget that mavericks are more the exception that prove the rule. And more often than not, you wouldn't trade places with them if you are actually given the opportunity.
You know, speaking of Hughes, speaking of I'm not comparing the guy that I'm about to mention, but paranoia. And just recently, Andy Grove of Intel passed away. Generally very highly respected individual of high achievement, but he has this one great expression, you know, only the paranoid survive. And I know you talk about paranoia a little in your work. How do you feel when you hear that from Andy Grove?
I mean, look, I think the idea of, you know, the Stoics were very big on negative visualization, sort of thinking of the worst case scenario. So you're aware of it and you're prepared for it. I think if you're using a line like that to just be vigilant, you're great. But there's another Stoic quote from Seneca where he's saying, I think it's like, fake fears generate real fears, right? And he's saying, generally, the things that we're paranoid about become a self-fulfilling prophecy where, you know, hey, I'm scared that these employees are going to screw me over, so I'm not going to trust them, and then they're not going to be bought in, and then they actually are going to try to screw me over, and then I'm going to tell myself that I was right, when in reality I made myself right with my own stupidity and short-sightedness. And so I think paranoia, you know, if we're using paranoia as a synonym for vigilance, okay. But if we're actually using paranoia, which is, you know, you're seeing a monster, or, you know, behind every door and a tiger inside every bush, you're probably going to do far more damage than if there actually was, you know, a tiger in the brush.
We talked about it early on. So far, I've led you through kind of, we're talking aspiration, we're talking success. But a big piece of this newest work of yours is failure. And I brought it up earlier that doing is enough, but because many people don't get this, that you could do everything right, everything, and you can still fail. You can still fail. I mean, Jim Rogers wrote this book, Investment Biker. He's got this great quote about, like, look, you can spend 20 years going down this path. You might become, you know, the next Kirov ballerina, you know, travel around the world on a motorcycle. But guess what? One wrong mistake and you could blow it all and you got nothing to show for it.
Yeah, or you know, the effort is enough, right? I could write this book and I could do all the marketing, and then a hurricane could happen the day it comes out and all my media gets wiped away and no one's interested in reading a book, right? Like, that can happen.
Dealing with that, though, thinking about that, thinking about that possibility, and then being able to deal with it, that's the crux of it.
Yeah, right. Easier said than done, obviously. And I think the other part of it is okay, what am I going to let that failure say about me as a person? Hopefully nothing, right? Like that. I think that's the other thing. So if you're in a position where succeeding makes you feel good about yourself and gives you your confidence, then what's going to be problematic is that when you fail, you're gonna tell yourself it says the same things about you as a person. Like they say, if you read the good reviews and listen to them, then you got to take the bad reviews the same way. Ideally, you should take none of the reviews, right? You should focus on your own judgment of success. You should focus on your own internal metrics. Warren Buffett talks about this, having an internal scorecard, not just an external scorecard. Just because an investment turns out to be right doesn't mean that it was a good investment. What if you made it out of ego, or you made it out of ignorance, or you made it out of laziness? If you let the external factor, if you let the fact that it was ultimately vindicated by the market vindicate the subpar decisions that went into it, now all of a sudden you've just established a very bad habit.
One of the things that I love about this, what you've put together, is that, and we mentioned at the very beginning of the conversation, it's not necessarily only for, or it's not necessarily geared to the brand new beginner in business, life, whatnot, that doesn't have a lot of experience. So if you do have some experience and you do have some scars, when you see things like a Fight Club moment, that really punches someone like me right in the gut, because it's like, wow, you really need to have a great life of achievement and to keep pressing and keeping on that iterative track. These Fight Club moments, I mean, man, you got, if they're not just randomly happening, you have to go find them. Yeah,
or I mean, look at all the people that sort of got caught when the tide went out during the financial crisis. Like, you could say, hey, that was unfair, that was crappy, or that shouldn't have happened. Or you can say, hey, this was a reminder to me. This was a learning experience. This was proof to me of why these things matter. I think we all need, if it were possible to learn everything by books, that would be great. But the reality is some lessons can only be taught by very painful experience. And oftentimes those are the things that we want to hear the least, but we need to hear the most.
But you also have this great quote from Bismarck. In effect, any fool can learn from experience. The trick is to learn from other people's experience. It's a balance.
It's totally a balance. Yeah. Ideally, you want your failures to be painful, but not fatal or not near fatal.
Talk about also this feeling. And if you want to relay a little bit about your experience, that'd be great. But, to go through aspiration, success, failure, to get to the other side of that mountain and then say, okay, I might have to start over. But that feeling of going through that process, those, the aspiration, success, failure, and then coming out on the other side and then kicking it into gear again, that feeling is really a magnificent feeling.
Yeah, well, I think I see it as each person is at one of those phases at any given point in their life, and it's a constant process. So, you're young, you're aspiring to do something, and you fail. And then you've got to decide, okay, am I going to try again, or am I going to stay here? Or you're aspiring to something and you succeed. You either aspire to something greater on top of that, or you mess it up and now you're dealing with difficulty and adversity again. So we're constantly there, and I've been in all those phases myself, and I'll be in all those phases again. With each thing that we do, we're you sit down and start a project. Okay, you have a goal for it. You're either going to be successful, or it's going to turn out to be much more complicated and harder than you thought. You're always there. Not only is it that you're always there, but whenever you are there, the worst thing that you can introduce there would be your ego, your delusions, your entitlements, the idea that whatever this is says something about you as a person. That's just the worst variable for each in all of those phases.
You're kind of an old guy in a young guy's body. You know this, right?
I feel very old, yeah.
Yeah, you're not like, the stuff that you read, the stuff that you're into. So I'm curious, your perspective, though, as I look at this work, the demographics. And if look, the millennial generation is catching a lot of heat these days. Basically, as far as I can tell from major media, it's just kind of tuned out, not interested, or I'm not even sure how to describe. But have you thought about how your work presents, this particular work, would present to different age groups in the year 2016? And would those groups take it differently? For example, is social media obscuring a younger generation to even being able to accept some of the things you're saying? I still feel like I got one foot in the grave because I know what pre-internet felt like. So I know what post-internet feels like. But I mean, do you think there's some of the messaging that you're giving that some younger people, I mean, look, the messaging of their world is like, why do I want to listen to Sky Holiday? All this stuff is like old guy stuff.
Yeah, I mean that is something I thought a lot about. I mean, I started the first third of the book, I think, is mostly directed towards someone who hasn't accomplished something. I think people who have accomplished something can relate to it and will appreciate the fundamentals. But yeah, like my generation, grew up with social media, and so the idea of telling everyone what you're going to do and getting congratulated for it in advance is endemic to my generation. I think it's prevented a lot of people from actually doing the things that they've set out to do. I did direct a large part of this to people my age, but I mean, I think at the end of the day, every generation goes through these growing pains. Not every generation graduates into a massive financial recession, which I think has had some knockdown effects. But my goal with my books is that wherever you are, you find some value. You find some value in what I'm talking about, and I want a young person to be like, oh, this is exactly what I needed to hear. Thank you. And then I take a lot out of hearing older, successful people telling who have been through even more than what I've been through, telling me that, hey, this stands up. You got it right. Because I'm writing both for a younger version of myself, and then I think writing for what I'm going through or feel like I'm facing next. So I'm writing for myself who like you sort of has a foot in both camps.
The book, Ego is the Enemy, Ryan Holiday. Ryan, where can people go to find out about you? And one final question, no subtitle. This really talks about the power that you have in the publishing industry now, because how did you talk your way out of that? They all want to give you a subtitle.
Well, thank you for noticing. No one's noticed yet. I just felt like there wasn't a subtitle that said more than the title, and my publisher thankfully agreed with me. But I feel like Robert Greene gave me that advice at some point. He said, like, ideally you just want the book to be the book. No one remembers the subtitle anyway. So that's what it is. My website's ryanholiday.net, and I'm at Ryan Holiday on Twitter.
Book availability?
Everywhere. It's out in the UK a month after in the US, but it's out everywhere in the US on June 14th.
Ryan, keep writing. I always have fun reading your stuff.
Thanks, man. We'll talk soon.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.